Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. This is a Friday morning. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. As always, I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, good morning.
Hi, morning, folks. I was away for 2 days, but lots of action in the market. I mean, and all over the place with respect to the FIIs. And yesterday, some global concerns creeping back in. So, I mean, it's not a dull Friday, shall I say.
Well, that's right. The Friday evening will be more interesting, I guess. But for the markets, I think we are in a bit of a consolidating range. Yeah. Yesterday, we pulled back because of expiry. But plenty of cues, Prashant, and the US markets will have a longer weekend as well. So that's another point.
Monday's a holiday, so
yes, for them.
We will, of course, be trading into that. But directionless, I mean, largely directionless in terms of US session, if you look at equities. But I mean, equities really is not the story. It's not been the story for the last 3-4 days out of the US, as we've explained, of, every day now. So let's just get to the story then, right? I mean, so the S&P was flat, the NASDAQ was up about 0.25% or so, nothing very much at all. But essentially, bond yields did a complete round trip. So, we had one more big spike as far as US bond yields are concerned across the curve, 5, 10, 30. Not at the very near term. This is all happening at the longer end of the yield curve, like what we saw in Japan as well. It's not the shorter end. So the 30-year, for example, hit 5.14 intraday. And then it pulled back 10 basis points from the highs. So it was pretty significant, and we ended actually slightly lower on the 10-year on a day-on-day basis, the 30-year, that is. The 10-year was down 7 basis points, so we left off at about 4.52 after hitting the near 4.6% kind of level, same time when we were sort of talking about this yesterday. So a bit of a round trip across the yield curve is what we've seen. Dollar index struggled to be above 100, so ended just under it as well. So is it profit booking? Is it dip buying? A little bit of short covering as far as US Treasury futures are concerned? Possibly, yes. And that ahead of the long weekend in the US. Otherwise, there was no real big reason for this kind of... I mean, there's no news trigger per se, which kind of caused this big round trip. Yields shooting up and then sort of closing slightly lower on a day-on-day basis. US markets are shut for a Memorial Day holiday. So that's the other thing. Now, House Republicans have managed to pass narrowly, but passed the revised tax bill, the Trump tax bill, the one big beautiful bill, as Trump has called it, and sent it to the Senate. Now, the Senate has got 18 days to pass it. The aim of the Trump leadership, the Trump team, has been to sort of get this out of the way by the 4th of July. That's the goal date for the Trump team to pass the bill. I mean, it may happen, may not happen, but the fact that the House has cleared it already ahead of deadline. The deadline was for this to happen was Monday. But since it's already happened, maybe, we'll have to see what shape, form, what additions, changes the Senate makes before this actually is this is done. We put this out on Monday as well in terms of some estimates which suggest that Trump's tax sort of, bill is going to add, the spending bill, whatever you want to call it, this bill is going to add over a period of time some $3.5 trillion in deficit by 2034. So that is the focus, and there is a fair bit of criticism as well. I mean, tax cuts now, spending cuts later. So what happens is whatever cuts you make, and it's not just in the US but everywhere, whatever cuts you make, whatever changes you make, that more or less tends to start to become a little permanent. So we'll see. But this, of course, this along with the downgrade that we saw, the rating downgrade that we saw last Friday, have been the two drivers as far as yields are concerned in the US. These are not the reasons why bond markets have behaved, but I think this is the symptom, especially the rating downgrade, pointing to the fact that there is more spending coming, irrespective of what Trump or others have said they want to do to contract the size of the government. The other one, of course, was US PMI numbers, which surprised to the upside for the month of May. And this kind of points to what lots of Fed officials have said, that how do you read this data? Because there is there are tariffs imposed, then there is a stop, then there is a start. So it's very, very tough. And it's only going to be sometime in fall of 2025 when data starts to mean something for them to be able to use it as a signaling device. Next week is going to be important because, again, from the bond market perspective, US Treasury has announced auctions, 183 billion total auctions, and these are sort of different durations. So there is one on Tuesday, one on Wednesday, one on Thursday. Is there going to be demand and strong demand? Is it going to be weak? What will happen? I think these are questions which are important for bond markets and what happens to yields. So next week, in that sense, remains important. By the way, some are talking about whether it's already time that the Fed is going to step in. It's very unlikely. I mean, or whether the Treasury does something, the government does something, cut the size of the auction itself to match supply and demand. It's happened in the past, back in 2016. But again, I mean, I think these are all things we'll have to wait and watch for. But this is the big driver, at least from a US perspective. Here in India, just to tie in the levels, I mean, yesterday we managed to close, we broke the 20-day moving average intraday, but we managed to close above it. The number now, as of yesterday's close, stands at 24,525. So that remains the first level. On the downside of the market starts to drift again. Downside level, which should hold, is 24,462, which is yesterday's low. We should not break above it. And then, of course, below that, there is a 20-day moving average. On the upside, of course, it's the high of 25,116. But I think, in the near term, just be focused on some of these levels on the downside rather than, hurrying and worrying about how quickly we're going to be able to take the upside levels out. Nifty Bank broke the 20-day moving average, but managed to close above it. That is, again, it's not very clear. It's a little confusing out there. So I think a day, 2 days more of action. The expiry yesterday is out of the way, maybe a cleaner picture now. On the way down, the swing low for the Nifty Bank is 54,690, which needs to hold. And below that, you've got 54,031, which are important levels to watch out for. GIFT Nifty will give you a quick sense of how we are likely to start, and we'll pick it up from there. 40 points higher on the GIFT Nifty. Surbhi.
Absolutely, Prashant. And this is because Asian equities are actually holding up fairly okay. Yeah. But this bond story is the really big one. And not just the US, even Japanese long-dated bonds, they've been rising. German bond yields, they've been rising. So globally, I mean, started with the US, but it seems investors are a little disenchanted, a little uncomfortable with their bond holdings right now. There's a lot of shift going on in the money markets because of this. And this is actually weighing on sentiment overall. We've seen that the US market has been down 3 days. Now the futures are a little positive, and that's why Asian markets have also picked up. But 3 days of decline coming in, and the US indices, by the way, so far this week are already down 1.5 to 2%. Now let's see if they snap that trend today. The 30-year bond touching that level of 5.14, almost 5.15, that became a huge talking point, and the yields then cooled off from there. But the fact is that they remain very elevated, and like I said, not just US, but investors are watching what's happening in Japan and in markets like Germany as well. The crypto market rallied because there seems to be a lot of debate about whether you want to shift your holdings now. It should not be all in US Treasuries or Japanese bonds. Crypto is seeing a big move. In fact, the Bitcoin is virtually at this new level of 112,000. It touched 111,999. And it's not just Bitcoin, but all the asset classes, Ether, etc. All of these cryptocurrencies were up between 3% to 7%. This was overnight. Asian markets today, like I said, they've managed, at least for now, equity markets have managed to shrug off a lot of this concern. And there's some green on the screen, not just in Japan, in Hong Kong, in Singapore. Most of the regional markets are actually up and about. Even the Japanese market, the Nikkei, is actually up. There's inflation data out of Japan, which is pointing to upward pressure. Core inflation in Japan is at a 2-year high, 3.5%. The headline inflation number is as expected at 3.6%. But the rise in core is what the Japanese markets are tracking. Otherwise, headline inflation is rising because rice prices have been very, very high in Japan. So let's watch for this. Now let's come back to our market. So what have we done this week? It's been consolidation, but with a negative bias. The Nifty is down about 1.6%. Mid caps have fallen a little less, 1.3%. The micro cap and the small cap market relatively unscathed. The cut there is only 0.3% on the small cap index. Now the issue is with flows. Flows are very patchy. Let's talk about yesterday's number. Yesterday, again, we had a big sell number, 5,000 crores on the downside, domestic institutions buying. But look at the trend, the preliminary data for this week. We started Monday with a small sell figure of about 500 odd crores. Tuesday was a gigantic sell figure of 10,000 crores. Wednesday, they turned net buyers. And finally, again, Thursday is a negative number of about 5,000 crores. The overall cumulative, those are the bars that I'm talking about. Now, that's the provisional data for this week so far. It's all over the place. overall cumulative, the month of May has still been very positive for FPI flows because we've got net inflows about 19,000 crores, but that includes your block trades, etc. This is the trend that is a little, iffy at this point in time. So let's watch for this. Lots of stocks in focus as we get into the fag end of earnings season. ITC. Some people will say it's disappointing, especially the FMCG business. Cigarette volume growth is okay, but there's pressure on margins. Sun Pharma, the US business, as well as the global specialty business, that has missed expectations on the revenue front, but margins have done well for Sun. So let's watch for this. Honasa, 200 basis points decline in margin year on year. That's a reality. Top line is growing, but are they getting the house in order or not? So let's watch for some of these numbers. By the way, there are some Sensex changes as well, just to quickly put this on your radar. Nestle and IndusInd Bank are going out. Trent and BEL are coming into the Sensex, and this is all effective June 23rd. So we'll watch for all these stocks because of the passive inflow-outflow that might happen. And last but not the least, we're talking about global bonds and what's happening in global money markets. Well, it's an important day for us here as well because the RBI board will today decide what kind of dividend it wants to give to the central government. The estimates are as high as 3 lakh crore to 3.5 lakh crores. That's how much the RBI could give the central government this time around versus about 2.1 lakh crores last year. So let's watch for this. Lots of action to keep us busy. Nigel.
Well, yesterday was a weekly expiry that played out. It was very, very exciting and a perfect expiry that did play out because the bears, they thought that they had all the cards with them. And towards the end of trade, the bulls, well, they fought back. So you just take a look at it. At around 3 p.m. odd, things did turn around. So a classic expiry is what played out. As you mentioned, yes, the global Q is a little bit of a tizzy because we are seeing that movement on bond yields as well globally. And that's what's making, the bulls a little bit nervous. But the good point is the India VIX continues to cool off. We're not seeing any big spike out there. Yesterday as well, we ended low. But the VIX continues to remain at around that 17, 18 odd mark, which is very, very manageable. Remember, earlier in the series, we went to around 22, 23 or thereabouts, and we've cooled off from there. What did the FIs do? Well, they sold in the cash market and they added shots in the futures market. So on index futures, they added close to around 10,000 contracts. They unbound some longs as well. They remain net short with close to around 68% of their positions on the short side. And for this week on the whole, the FIs, they have been adding shots and the clients, they have been adding longs. So that's going according to the script. The look on the screen that should come up for you. The FIs being net short, you want some shots in the system. The markets were devoid of any kind of shots. And that's what they have done. So if you just take a look at it, from around 23,000 contracts, it's gone to around 55,000 contracts. And the client positioning as well, they are building on longs. This is actually a favorable scenario when you have the clients going long and the FIs moving short. Keep in mind the RSI on both the Nifty as well as in the Nifty Bank, they have cooled off. They're spurted away to around 70 odd. The last time I checked, in fact, it was below that 60 odd mark. Options data, extremely crucial out here. One could say there could be a strategy that's playing out at around the 24,600 call and the 24,600 put. So you write both of them, you pocket close to around 400 rupees or thereabouts, and then you're playing for a broad range on the downside 24,200 to around 25,000 odd. But just going by the screen, it's telling you that the call writers, they feel that they can defend the higher levels of around the 25,000 odd mark. So the crucial resistance mark going by the options data is around 24,850 and around the 25,000 odd mark. On the downside, the options data suggests this 24,420, that will become a bit of a support zone. And yesterday's low, you don't want that to get breached. So this is the crucial support zone that you're talking about. But in the last 6 trading sessions, the Nifty has consistently been making lower highs. Just take a look at that screen. That's telling you lower highs is what we have seen. So for today's session, I'll want the Nifty to get past this, to give the bull some kind of confidence. We continue to remain in a range, but you'll want to see the high of today breach this level. So that will break that 6-session trend that we've seen of making lower highs. The Nifty Bank, that as well did pull back to around 54,500, which is the level that we called out for yesterday. And that saw a good recovery. So you wanted to continue to defend this 20 DMA or thereabouts. Don't want it to break down. So I think we're in a bit of a range, but the 24,400 odd mark, crucial support zone.
All right, Nigel, thanks very much for that. So that's the picture as far as the setup is concerned. Let's bring in Drew Pettit, who's with us now, director. He's with, of course, Citi right now, and he's joining us now. Drew, great to have you with us here. Thank you very much for joining us. Just a quick word, Drew, on this entire US bond markets and what they're telling us. Even after last night's big intraday reversal, US long-end yields are about 15 basis points higher in the week. And they're about, in the month of May, I mean, if you take, say, for example, the 10-year, it's up some 50 basis points. So it's crept up and crept up to a fairly high level. The question really is, when does it start to hurt equity markets?
Honestly, short term, it's probably not hurting them because we're coming off such a low level of sentiment after Liberation Day. So we got some momentum after we put it in a bottom. We saw a moratorium on tariffs. That really helped sentiment improve. All good, but honestly, that's short term. Long term, I think yields are already denting what fair value for the S&P could be. Honestly, what we've seen in the last couple of weeks, like, yes, long end rates are a big part of this story. So higher long end rates, we think lower fair multiple for the index, but that's also come with a lower dollar. So when the dollar is trending lower, again, I think you can take, some multiple point turns kind of off the index as well, at least fair value in a sense. And then pair that with number 3, another negative here is widening credit spreads for US companies. So higher treasury rates, a lower dollar, and higher US credit spreads all sets us up to a point where we think the high end of kind of fair value for the S&P 500 has moved from 24 times, justifying where we're trading at today, to something closer to 22 times. So we think the valuation pressure is already starting to creep in here because of the rate moves and the other macro moves that have been associated with it.
And 22 times translates to what at an index level, Drew?
So right now, the index is trading at 24 times, closer to 24 times. So 22 times, again, you're probably taking off, let's call it, maybe 500 points on the index of fair value.
Okay, so closer to maybe 5,300 on the S&P 500, I suppose. But then valuations are only one part of it. So many other things that go into making up the market's mind, right? Drew, on bonds and really what's going on. Last time, you remember, the US president did listen to the bond market. That's when the 90-day pause happened on tariffs. Remember, the yields were spiking higher, and then everybody was saying the bond market forced the president's hand. But I don't know, because this bill is passing through. Apparently, it's going to blow up the deficit by some $3 to $5 billion for the US. $1 trillion, beg your pardon, for the US.
Billion is nothing.
Billion is nothing. Billion is like pocket change. That's true. But the thing is that, how should investors prepare for it? Investors in emerging markets, you're saying that on valuation, US equities are high. There's money moving away from the bond market. Will it get worse before it gets better? Will markets just ignore this? It'll be usual noise, deficits up, you pass another bill, and life goes on.
Look, honestly, this is something that keeps us up at night and has, probably for a few years now. So yeah, two things that keep me up at night: interest rates and my 2 kids. But honestly, this is something that does matter and will matter more the higher rates move. So right now, again, we're uncomfortable with valuation, but what we still have in the background is a whole bunch of really exceptional growth stocks in the United States that you can still buy. So I love that intro in that question. Valuation is only one part of the story. As long as we have secular growth in the United States, there are still some assets in the equity markets you want to buy. Honestly, this is why our pitch has really changed from thinking about index direction, because it has been messy when it comes to headlines and news flow. But what has not been messy is we still have conviction in growth stocks. We still like the NASDAQ over US small cap. We still like tech, excluding kind of the tech hardware names that are very tariff exposed. We like the communications names, again, secular growth stories. So growth to us is defensive, and it's a great way to fight back against valuation because you can grow that E into the higher multiple. So again, broadly, maybe the S&P needs to, back up a little bit and consolidate after a big run. But the growth stories in the U.S. are still there. It's still worth owning.
But Drew, only in U.S. tech, right? Just, quick follow-up, 10 seconds. But you're saying growth, it's a very narrow market then that we're talking about for the next couple of months?
At least, fundamentally, yeah, you're right. The cyclical side of the market, even the defensive sectors, you've seen a massive haircut in earnings expectations for the year. So yeah, getting a little bit more narrow, growth is a little bit harder to find.
All right. Hi, Drew. Morning. Nigel on this side. And please give those two little kids a big hug from my end as well. Where does in the Indian markets fit into your scheme of things? Because you have told us in the past the Japanese equities is what you like, Europe as well. I recall that call because there was not too much attention on the European markets. And boy, oh boy, have they done well. But given the entire global backdrop, where does India feature?
Look, I got to give our global equity and European equity colleagues a pat on the back for a great call on Europe. But, emerging markets are underweight to us. But India specifically, our EM strategists have that as an overweight within that allocation. India provides defensive growth. So back to you're worried about global growth and global trade. You're worried about valuations in some parts of the world. You want to go to where you have conviction and growth, and India provides defensive growth. If you can't get something cheap, I might as well get something that's growing.
No, absolutely. Just last question, Ru. Does your team have a view on the 10-year and the 30-year? I mean, where do yields go? Is the 10-year headed to 5? Is the path of least resistance up?
Look, we've been very range-bound. It feels like this move is very aggressive. But we were kind of looking at kind of a 480 top end on the 10-year and more of like a 420-ish or so kind of base. This does feel like a big move, but in the grand scheme of things, it's really stayed within our rates team's bear and bull case.
Okay, 4.2 and then 4.8 on the higher side. So that's the picture coming through. Drew, great conversation as always. Thank you very much. And appreciate you joining us as always here on CNBC TV 18. Till our next chat. Well, I think let's just quickly run you through what's lined up here in terms of interactions that you will see over the next 2.5 hours. So Deepak Fertilizers will be with us to talk about their fourth quarter numbers. 9:40. Abneesh Roy of Nuvama Institutional Equities to talk about earnings for Colgate and ITC. Mahesh Patil of Aditya Birla AMC on markets at 9:15. Metro Brands will talk their business at 9:30 and the outlook. PI Industries will be speaking with us after their earnings at 9:40, 9:50. We'll have the Management and Container Corporation of India. And towards the end of the program, we will speak with Mohit Bhargava, former CEO of NTPC Green Energy, and Sumit Kishore of Axis Capital to discuss execution challenges in the power sector and India's renewable energy transition. Stay tuned.
Let's take a small break. Come back. We'll focus on all the stock-specific action. Our special top 10 segment. We're looking at ITC, Metro Brands, Honasa, GMR Airports, Power Mech Projects. All of them will be reacting to positive news flow. On the flip side, we have Sun Pharma, Grasim, Ramco Cements, Container Corp, and GSPL that will be reacting to negative news flow. Take that break. Come back. Get into further detail on all of these names.
Welcome back. So all of those debt concerns and bond yield concerns aside, actually Asian markets have chosen to have a nice shade of green. Most of them at least. The Taiwan market is also now turned positive and the Nikkei is up about 0.7%. Because of this, the implied open is telling us that we'll have a positive start, 30 points up. So let's see if we can break the so far downward drift that we've seen this week. Our team is standing by, lots of stocks to track as well. So let's get to the CNBC TV 18 list of top stocks to watch. Guys, morning to all of you. Let's start with all the big earnings that came in after market hours. Ekta, Sun Pharma, how does it look?
Well, interesting set of numbers because it was largely operationally in line, but what probably is going to disappoint the street is the commentaries. So the company did indicate that they're looking to invest $100 million in terms of additional costs on products, which should probably weigh down on the margins according to analysts. The company is also increasing its R&D costs to 6 to 8% of sales. Now, FY26 guidance is mid to high single-digit top-line consolidated growth versus earlier years generally, which have been high single digit to low double digit. So maybe the street is probably going to look at it a bit cautiously. The management did say that it is based on global uncertainties as of now. Revenue growth was marginally below estimates. What stood out was that US sales did not hit that $500 million mark as anticipated, came in at around $464 million, and global specialty sales came in at around $295 million versus estimates of over $300 million. So that's probably the reason why I expect the stock to be a little weighed down today. Overall, in terms of numbers, revenue was up 8%, margins 28.7% versus estimates of 27.7%, and profit of over 2,150 crores.
Okay, all right, Ekta. Thanks a lot for that. Well, let's hop across to Mangalam. He's here to tell us about ITC's numbers. Mangalam?
Well, ITC was a mixed set. There were some hits and some misses. So largely in line if you net all of that. If you look at the revenue, that was mildly above street expectations, 17,248 crores as against expectations of 16,820 crores. And the cigarette volume growth between 4 to 5% at the higher end of the expected band of 4 to 5% itself. Street expects that it has been about 5% for the cigarette volume growth. However, what's not good is that we've seen the EBITDA miss street expectations. EBITDA was shy of 6,000 crores as against street expectations of 6,100 crores. Margins also missed street expectations. And FMCG revenues grew 3.7% versus expected 6 to 8%. Here as well, the margin contraction of 270 basis points, the higher end of street expectations of 200 to 300 basis points contraction. What is it that the management said? They saw sharp escalation in key input materials. FMCG saw competitive intensity highly, more so in the notebook division. So if you strip that, the growth was 5.4%. And rice exports scaled up in the second half. That aided their overall agri-business. On the back of mixed set of numbers and the fact that the stock has not done much, I go with mild green because there's no reason to either sell or buy ITC at these levels with the kind of stock performance that we've seen. And an 8 rupee dividend doesn't hurt. So going with mild green on ITC.
All right, Mangalam, thanks very much for that. You'll hear from Abneesh Roy weigh in on the companies at 9 o'clock, ITC and Colgate in focus there. But let's talk about Grasim. Nigel, tell us more.
Well, Grasim, you know, the core business, the core standalone business, that was a little bit disappointing. But otherwise, the new businesses, which is the B2B business as well as the paints business, that's ramping up as well. Let's run you through the basic numbers. As you see, the EBITDA number, well, it came in at around 220 crores. That compares with around 335 crores or thereabouts. So clearly, that was a miss with regard to the standalone operations. Even if you look at it, the VSF business or the fiber business, there's a sharp degrowth that you're seeing on the EBITDA front because pricing is weak, demand as well has been weakish. While the chemicals business, though, did well on a low base, both those two business verticals have missed streets estimates by roughly around 20-22% or thereabouts. But there is some good news because the newer businesses, which is Birla Opus and Birla Pivot, both of them have started improving. So the B2B e-commerce business, that has shown some kind of improvement from around 900 crores. Now it's scaled up to around 1,200 crores. And for the year, they've achieved close to around 5,000 crores, which is good. Even the paints business, from around 700 crores, it's perked up to around 950 crores or thereabouts. And the losses as well are reducing gradually. So from around 350 crores a few quarters ago, that's gradually come down to around 315 crores. The management goes on to say that based on their estimates, they have become the third largest decorative paint company here in India. As per the exit rate of Q4, and also by capacity, they're more than 21% of the market. The net debt number came down a little bit because some of the rights money did come in. So expect the stock to open up in the red. The positive, though, is that the paints business is ramping up. The e-commerce business is ramping up, B2B e-commerce business, though, in fact, the losses do continue. But let's hop across to Mangalam. He's tracking a whole host of names, Metro Brands, as well as Honasa. Mangalam.
Well, what's common between both Metro Brands and Honasa is the last 3 quarters weren't very good for them, but now they are seeing signs of improvement. So let's start with Honasa, 13.2% revenue growth. However, that's come at no expansion in the EBITDA. In fact, the EBITDA has declined by 18%. Margins too have come off from 7% to 5.1% with a net profit decline of 18%. That's because ad spends have ramped up and other expenses are higher on account of the distribution reset as well. But what's positive is a 13% revenue growth is higher than the FMCG industry, led by 21% underlying volume growth. Some of the core products of Mamaearth, which is their core brand, growing in double digit, and some of the ancillaries like Dermaco and the other companies doing well for them too. So expect, because the stock has halved, expect some green on Honasa. Metro Brands as well. I'm going with green because after 3 quarters of single-digit revenue growth, they've reported double-digit revenue growth, 10% growth on the revenue, and that's reflected in their margins as well, which have improved from 27% all the way up to 30%. The net profit is lower, largely because of a tax credit in the base quarter. The company said the EBITDA has improved due to better cost control and reduction in losses in the Fila segment, and liquidation of old inventory of Fila has been completed in the 3rd quarter. So going forward, operational performance is likely to improve with revenues improving on account of new brands that the company has been launching.
Okay, all right, Mangalam, thanks for that. Well, Ramco, these numbers are disappointing for the past quarter. Yes, the street was bracing for a weak set of numbers, but this is even weaker than what the street was working with. And the problem is top down. So the top line itself, they degrew by close to 4%. Some on the street were estimating a volume growth of close to around 3 to around 6%. So that's clearly disappointing. And what's even more disappointing is it seems they're facing pressure with regard to pushing out their volumes. Because after a while, I've seen that Ramco in their core market has actually underperformed the industry with the degrowth on the volumes front. So that's disappointing. And that's why the revenue, EBITDA margins, all of them are a miss. Now, the PAT number, that took a harder hit because that degrew by close to around 74%, while the EBITDA number was down by close to around 23%. Because they've commissioned capacities, the finance cost as well as depreciation, both of that went up. However, the management has stated they're on this plan to sell their non-core assets. And because of that, you've seen the debt gradually come down from close to around 5,000 crores. Now it's at sub 4,500 crores. And for the past year, they have monetized close to around 460 crores out of that promised 1,000 crores. And they're saying the remainder will be done by July 2025. So the deleveraging plan is working as per plan. The outlook, though, is good because they are saying that prices have gone up both in trade and non-trade segment, and that's what will bode well for profitability in the coming quarter as well. So the stock starts off in the red, and we'll have to see whether or not the street wants to look ahead and brace for better numbers ahead. But let's hop across to Vivek. Vivek, tell us about GMR Airports as well as Power Mech.
Well, good morning. GMR Airports, late last evening, the company declared its results. Now, it was operationally a better quarter, but one thing that the street will be wary of is the fact that debt has increased both on a year-on-year as well as on a sequential basis. Looking at the numbers, revenues higher by close to 17%, aided by almost a 9% increase as far as passenger traffic volumes were concerned. EBITDA up 23.2% on a year-on-year basis. EBITDA margins are quite steady, almost 180 basis points higher on a year-on-year basis. But higher finance costs, higher depreciation, higher tax expenses, all of this led to a loss on the bottom line, a loss of close to 237 crore versus a loss last time around of just around 120 crore. So this is something that the street won't like. However, what is it that the company has said? The company has said that going forward on account of the revised upward tariffs for the Delhi airport, the company expects better aero revenue, better overall profitability and cash flow generation across its airports. Now coming to Power Mech projects, it's a strong finish as far as Q4 FY25 is concerned. Revenues higher by 42% on a year-on-year basis, EBITDA higher by 44%, margins too very steady at 11.6% versus 11.5% on a year-on-year basis, and profitability higher by 54%. The company is yet to upload its investor presentation, but remember, at the end of Q3, the order book was quite strong, in excess of 57,900 crore. Expect a green on both of these stocks. GMR Airports, however, on account of the red figure, may see some booking.
Okay, got that. Thanks very much, Vivek. So green on both of those. Let's go back to Mangalam. Mangalam Concor, how did it fare?
It's a muted performance, and the street was expecting no less out here as well because we already had the volumes disclosed and they were a far distance away from what the company had earlier promised, 18 to 20%. The overall annual volume growth was actually 8% itself. Board has approved a bonus, so that may keep the stock afloat in today's trading session, but by and large, nothing really to write home about in these numbers. A revenue decline of 1.5%, EBITDA declined by nearly 12%, which meant the margins compressed. The net profit declined by 2%. The reason why the net profit declined lower than the EBITDA was because of a change in the depreciation method in the third quarter. If you look at both the segments as well, EXIM, the revenues grew just about 3.4%, with the margins contracting 250 basis points. Even the domestic business, the revenues declined by 9%, with a 50% decline in the operational performance, and as a result of which, I expect the stock to see some red.
Okay, all right, got that. Mangalam, thanks very much. In fact, at 9:50, we will be in conversation with the management of Concor as well. Sanjay Swaroop joins in from the company to talk about the outlook, whether FY26 can be better than the way they've ended FY25. Well, with that, let's move on to Sudarshan. Sudarshan's watching out for GSPL. How was the quarter, Sudarshan?
It's a weak set of numbers from GSPL, mainly on the back of sharp drop in volumes. Company has reported volume decline of 11% on a sequential basis and 23% fall it has seen year on year. Coming to the headline numbers, profit was down 48%, revenue has fallen 9%, and EBITDA has slipped more than 35%, and margin has declined. It has seen a sharp decline. It has come at 52.1% against 73.8% that company reported in Q3 of FY25. Also, operating numbers were impacted by other expenses, which have seen an increase and have almost more than double. It has come at rupees 50 crore versus 20 crore in this last quarter. So I'm going with red for GSPL.
Okay, all right. Thanks, Sud, for that. Let's quickly recap our list of stocks to watch. The ones that have positive news flow or positive earnings are ITC, Metro Brands, Honasa Consumer, GMR Airports, and Powermech Projects. Stocks with negative news flow would be Sun Pharma, Grasim, Ramco, Container Corporation, and GSPL. It's an even split today between the green and the red. That's the equity list, stock list for the morning. Let's find out what's happening in commodities and cryptocurrencies, I would imagine. Manisha is joining in. Manisha, beyond crude and gold, Bitcoin was catching the headlines overnight. Good morning.
And it continues to do so. So it'll be a second straight day where we're looking at all-time highs continuing in case of Bitcoin. So 112,000 is done. Well, actually, Bitcoin is gained up by 16% in the month of May. A very strong increase in institutional ownership, corporate adoption, and JP Morgan allowing clients to buy digital currency have all been very, very supportive factors for this one. Well, actually, when you look at the Asian markets right now, perhaps cryptos is the only thing that's trading in the positive because we've seen crude oil prices heading for a weekly decline. There are statements that OPEC and allies will increase production for a third straight month in the month of July. We anyways have been looking at higher production from US. The inventories have been on the higher side as well. So all of those factors weighing onto the markets. After that very strong run that we saw yesterday in gold and silver, well, that also has gone in for some profit taking. So off its multi-week highs. And same is the case with copper aluminum, which was trading on the higher side for the last couple of days, have also seen some decline. A lot of uncertainty still into the markets there. And the focus clearly now is in the U.S. trade deals with various countries, while the markets over the weekend will also watch out for the U.S.-Iran nuclear talks. So ahead of that, some bit of a profit taking in Asia.
All right, Manisha, thank you very much for that. So that is, of course, commodities in focus. We're going to take a quick commercial break here. The management of Deepak Fertilizers joins us on the other side. Fourth quarter earnings in focus. We'll also have Siddharth Khemka with us for some fundamental stock conversation.
Welcome back. Lots and lots of earnings have been coming in. So let's straight away get to our first corporate conversation of the morning. The company on our radar is Deepak Fertilizers. The growth has been fairly steady, actually. Just to recap the numbers, I mean, I'm looking at Q4 revenues up 28%. The margin has declined by almost 300 basis points. So we have to get into that. Profit is fine, up about 20%. And as far as the year is concerned, it's been a fairly good year for Deepak. Top line growth of 18%. Margins have expanded to 19%, and the profit has doubled this year for Deepak. So let's find out what the trends are like and what the outlook is. Mr. Sailesh Mehta, Chairman and Managing Director at Deepak Fertilizers, is with us. Mr. Mehta, good morning. Thank you very much for joining in. So, let me just start there to understand what's been happening, because in your, your fertilizer business has been doing very, very well, but the mining chemical segment and the pharma specialty segment, that's where, perhaps one can argue that growth has not been as optimal as we would have liked to see. Fourth quarter trends, let's first go into this margin compression. What is a more sustainable level of margin? You're at 18% EBITDA margin in Q4. What are the factors at play, and what is a sustainable margin we can expect this year?
Sure. So broadly, we have now evened out at 18-19% margins. And as we move towards more and more of specialty, we will see a margin expansion coming in. And in terms of sustenance, if one were to see what has transpired, what has brought this kind of a result, and as we see an increasing trend, fundamentally there are three things strategically at play and which are now getting more and more validated. Number one is the beautiful alignment that we have with the India growth story for all of our three businesses, whether it is in terms of coal for power sector, or limestone cement for real estate or infrastructure, which is where the mining chemicals is beautifully aligned. Then when we come to fruits, vegetables, horticulture, which is where our crop nutrition business is beautifully aligned. And similarly, as India grows into the pharma sector globally and the specialty chemicals, that's where our industrial chemical group is very beautifully aligned. So the first aspect strategically which we are seeing, which is bringing sustenance, is this beautiful alignment with the India growth story. There's a very good tailwind.
No, absolutely. I mean, long term, no doubting that. But it's just the short term issues that we have to kind of go by. Mining and pharma, let's focus on these because here the growth has been either low or slightly patchy. So if you could tell us, in FY25, your mining chemicals growth was just about 3%. It seems that there was some capacity constraints with respect to nitric acid. Now tell us, how much will this business deliver? What is the top line growth? What is the kind of margin profile? Because even here you have your premium or specialty products, like I think this product called Eldan, if I'm pronouncing it right.
Yes.
So let's talk about mining. What is the volume growth you're expecting in the business this year, and what is the margin at which it will operate at?
So, see, we are almost reaching 100% capacity utilization, and which is where the new project that we have taken up at Gopalpur, where we are adding a substantial, capacity that will kick in, by H2 of next year. So that is going to be coming in a very timely fashion. Having said that, you're right that in terms of this shift from commodity to specialty, that is also something that is going to help us, shore up the margins as we go forward. Fertilizer side, as you're aware, we have virtually moved over from commodity NPK to crop-specific NPKs. And that is getting very, very positive feedback from the marketplace. In case of ammonium nitrate also, as rightly so what you have pointed out, we are the only ones who make the whole range, melt, high-dense product, low-dense product, right up to the hospital grade, which gives us, the segment-based strengths.
Sure. Mr. Mehta, just a question. I mean, since obviously it is the move higher up on the value chain on specialty products that's going to drive your, your margins and your overall P&L profile. You're at 22%. I think out of your total revenue, 22% came in from specialty products as of the end of last year.
Mm-hmm.
What is the scale up you're expecting this year? And I go back to my margin question then. You ended last year at 19% EBITDA margin. As the share of specialty products goes up, can the margin go to 20 or is 19 the best case?
No, so there is now going to be a faster move towards specialty because, the proof of concept is now already settled. The market has accepted. And there is a very good positive, I would say, push in terms of acceptance of the specialty products. So now the journey will be faster. We have also done something else from a restructuring perspective, which is going to get much more focus on specialties. All the businesses now we have unwind and restructured into separate corporate entities, where the focus, right from the board member to the lowest officer, is going to be specifically on that project to deliver these specialties. So the journey that we see now on is going to be a lot faster. And in a sense, because different products will have different premiums, I'm not in a position to precisely say, but it is overall going to, give a very positive fillip to the margins.
Okay, all right. Hi, Mr. Mehta. Good morning. Nigel on this side. A couple of numbers before we let you go. As you've told us in the past, you're debottlenecking, you're getting the ammonia plant, you're getting the technical ammonia plant as well up and running, which will help your growth. What is the debt in the books currently? What is the capex plan you have for this year? And by the end of this year, what kind of your debt will you have in your books, sir?
Sure. So broadly, as you are aware, we have taken up projects now further enhancing the capacity of ammonium nitrate and further enhancing the capacity of acids. Both the businesses where we have been there since the last 40 years, and both are riding on the India growth story. And that total investment would pan out to be close to around 4,500 crores. We are, I would say, a year and a half away from commissioning. And in terms of the debt, it's around 3,500 crores out. We brought in a reduction with the last year's cash, positive outflows, where we brought in a reduction of 120 crores. And going forward, since all of this debt is tied up, and including the interest cost has been incorporated in the project kind of thing, we don't envisage any issues as far as
But the debt goes up, right? To what level?
That would go up to 4,500 crores at a peak level. Of course, it will come down as we see the older projects now contributing more and more. Recently, we have also done CCD capital infusion of 800 crores. So that is also bringing a much better, balance sheet in terms of the debt equity for the projects and other needs.
Okay. All right, 4,500 crores, got one number. Second number, what about the revenue growth for the year in percentage terms? What will it be?
So we are seeing a very even keel, and as we see things pan out, as we are all aware that predictions are good rains. So from that viewpoint, also all our businesses will get a positive flip. So we look forward to continuing the same positive trend.
So mid-teens growth for the year.
Yes, I think it's in the right direction, as you say.
Okay. All right. Thanks a lot, Mr. Mehta, for joining in. We'll hold you to these numbers. Wishing you all the best for the coming year as you focus more on specialized versus commoditized products across your segments.
Indeed.
Good speaking to you.
Thank you.
Well, let's get in Sid Khemka, Head Research, Motilal Oswal Financial Services, who joins us on the show. Hi, Sid. Good morning. Well, a lot of numbers we've got overnight. From the Nifty pack itself, you had Grasim. Mixed set of numbers out there because core business is struggling, but the newer businesses, the losses have come down. So your view on that, if you could tell us?
Yeah, good morning, Nigel. Glad to be on the show. I think, yes, if you see the core business, both the core segments reported weak performance led by lower than estimated profitability in both VSF as well as the chemical segments. Standalone EBITDA has declined almost 60%, which is almost 40% below our expectation. Operating profit margins was at 2.5%. Versus estimated of 4.2%. What we see is that the chemical prices continues to remain low, the caustic soda prices, and that could impact the Q1 numbers as well. And hence, we believe that the core business would not contribute meaningfully in the coming quarters. However, if you look at paints business, that is something that the market is excited about, and that is where you see that losses have come down. The business within 6 months of launch has become the third largest decorative paint brands with the 5 of the plants started operations. The 6th one will be starting commercial operations, which is in West Bengal in the first quarter of or the first half of the current financial year FY26, which is again estimated to contribute to the overall growth. So currently we are expecting that they are about 24% of the decorative paints market capacity in India. And once that turns profitable, that could be a good contributor to the profitability. Hence, bearing the core business, which continue to remain sluggish, we believe that paints is something that could drive the stock going forward. Today, I believe stock could be under pressure and not much to cheer off from the core business. But from a long-term perspective, paints is something that the market would definitely track.
No, I got that. So we'll keep an eye out on this one. Sid, good morning. Good to have you here as always. Just a quick word, Sid, on what's happening with the broader market and some of the stocks which saw large moves. And I want to just get a word in on BSE. It's the best performing NSE 500 stock over a 1-year period. We put out the story, and of course others then put out as well, that the regulator is basically considering NSE's request to give them Tuesday for their expiry. So we don't know if it'll happen or not, but that was the story. Stock was down 4% yesterday. Any thoughts?
Yeah, Prashant, good to see you. So I think if you look at that is one stock which has consistently outperformed. We have been having a positive view. Q4 numbers where stellar, revenue grew about 7%. And what we are seeing is that in the derivative segment, they have been gaining market share. And they have this key expiry day on Tuesday where I think a lot of action is happening. And with NSE applying to the regulators to shift their expiry to Tuesday, that could be a big negative if the regulators were to accept. In the past, we have seen that with any changes that NSE does, BSE is also proactively moving its or plans to move its own Sensex expiry. Maybe if Nifty is moved to Tuesday, Sensex could be moved back to Thursday. So that I think market will take a look at it. But otherwise, what we see is that the core business continues to do well. We see that the latest, the last regulation where the SEBI clearly came out and said that each exchange will have only one benchmark indices on a weekly expiry. That is a very favorable regulation and augurs well for BSE's robust growth in the derivatives segment. So we continue to have a positive view. Yes, valuations are a bit expensive. Any correction and clarity on NSE's expiry plus the Sensex expiry going forward will give more clarity on the way forward.
Okay, all right. That's BSE always in focus, and let's see if we get new expiry days now across the two exchanges. We'll take a break. Sid, stay on. We'll have more questions in just a bit. Quick break. Come back. We'll also connect with our technical experts, Sudarshan Sakhani and Shrikant Chauhan, joining in on the technical setup.
Welcome back. Let's just quickly look at the GIFT Nifty. I think there is still, 7-8 minutes to go for the pre-open session. So 50 points higher on the GIFT Nifty still. So is this going to be with the expiry behind a different market, a little different, more cleaner? Let's get that perspective in terms of trades. Sudarshan Sakhani and Shrikant Chauhan are joining us with what they make of things. Gentlemen, good morning. Sudarshan, yesterday morning you were saying that it's not very clear. I mean, it's confusing signals out there. Maintain that view, Sudarshan, or what's the thing to do as far as indices go first?
Yeah, good morning. See, that sense of confusion remains, and the market resolved itself at least yesterday on the downside. Now, once the Nifty breaks significant support levels, it's difficult to get bullish and say, okay, today we are going up. In a choppy market, there will be days when the index comes down, and there will be days when it goes up. But then that becomes unpredictable. So we are now in a position where it's not easy to suggest the direction in which there will be a sustained move. So if you have some intraday trades, market has a sharp dip, then buy and then take profits on any small rally. That's the only trade that is possible. The best trade, of course, as usual, is not to trade. But since that advice is very seldom followed, look for sharp dips and exit immediately.
Not doing something is also doing something, it is the hardest thing to do. Because point taken, Sudarshan, and I think good advice. Shrikant, what about you? What's your recommendation?
Good morning, Prashant. Yeah, I think the way the market has broken its important support at 24,700, 650. I am of the view that now the market is going to take some time. It is going to consolidate. It is correcting to the larger rally that we saw from the lows of 24,000 to almost 25,000. So it's a correction to that, and the overall sentiment, if we consider, and the macros, then they are not supportive. So I'm of the view that at higher levels, we need to be careful. Around 24,800, 750 sort of levels, we need to be careful. And in case if there is any correction, then close to 24,400, 24,350, we should look for taking some contra bets in the market. And we should look for taking some mixed bets or mixed view sort of strategy in the market.
Okay. All right. Sudarshan, you go first then with regard to stocks. What's in your radar?
Well, it's primarily still buying because there are mid-caps which are giving good signals. Now, whether that sustains is something we don't know, but it's worth looking at them. Atul is a buy with a stop under 7,080. REC has gone through a deep correction. It's moving sideways and it's giving signs of an uptrend or a breakout. Let's see. It's a buy with a stop under 393. United Spirits, another stock, similarly, is an outperformer. Look to buy it at a stop of 1540. I have one intraday short, and that's a disappointment. Colgate, which was part of that FMCG pack, which was suggesting an up move, suddenly dropped yesterday. And that brings it into an intraday short with a stop above 2435. But I would still focus on the mid-cap buying.
Okay, all right. Yeah, Colgate was a result disappointment. In fact, we'll discuss that with an expert in just a bit. But Shrikant, let's come to your stocks as well. What are you doing today?
Good morning, Surabhi. Good morning, Nigel. Yeah, I think as Sudarshan said, I am of the view that we should look for taking those bets which are really showing some strength or major weakness. So in that specifically, Divi's Laboratories looks good. It is above its important resistance level, and it had spent a lot of time, close to 6 months, below the levels of 6,300. Now it is comfortably trading above the same. So I'm expecting this stock to do much better in the near term, and we can expect the levels of 6,800 or maybe even 7,000. So with a target of 6,800, we should look for taking long bet on DVs at current levels with a stop loss at 6,400. And the other stock on which we are bearish is Wipro. IT stocks are under pressure and they are finding difficulties to sustain at higher levels. So from current levels, Wipro is forming some negative continuation formation. Here around 245, 246, look for creating short positions with a stop loss at 248. And we can expect 230, 35 sort of levels in the near term.
Okay, all right, got it. Thank you very much, gentlemen, for giving us all the trading calls. We'll come back to you a little closer to market opening. Quick break right now. Come back on the other side. We'll have the pre-opening raise, and then as promised, that discussion on stocks like Colgate as well as ITC. What is the fourth quarter earnings print telling us? Abneesh Roy of Nuvama will join in. Okay, welcome back. We've started getting the first of the pre-open rates, and it's a downward start, about 100 and 120 points low. But let's see, it's only 1-2 minutes, so we'll figure out how it stabilizes. I just want to look at rates on things like ITC, some of the key big stocks that posted numbers after market hours. ITC, for the time being, is actually starting positive, 1.7% on the higher side. The other is Sun Pharma. Sun Pharma starting lower. With Sun, the issue is that their global specialty business as well as the US business, it's been subpar, below expectations. So the India business has done very well for Sun. That's Sun Pharma. And ITC, the problem is with the FMCG business and the market and the margin pressure there. Cigarettes is fine. But I think some of the commentary that I've been reading since morning is pointing out that this palm oil pressure on, especially on the FMCG side, maybe it'll start, waning. So that should work well. Stocks up. Speaking of ITC, let's straight away go to Abneesh Roy and discuss some of these trends. Abneesh, morning and happy Friday to you. So Colgate and ITC both on our radar. Let's start with ITC. What did you make of it? I think cigarettes, everyone is saying it's fine, the kind of volume growth and overall, 5-6% growth. But this FMCG pressure, what did you make of it?
Yeah, happy Friday and thanks for having me. So ITC, what we see is some more time correction can happen, but the worst is behind from a stock perspective. We had highlighted that the stock could come under some pressure because of two reasons. One, of course, palm oil is impacting the FMCG part of the business, which you highlighted. Our sense is worst is behind there. From the top, there is a almost 20% kind of a correction in palm oil cost. It is still inflationary, but my sense is from Q2, a lot of the food companies which were severely impacted because of palm oil, for example, Bikaji, Britannia, Nestle, and ITC also will see improvement starting from Q2. So we are behind the negative news on that. Second, Godfrey Phillips has been growing much faster in cigarette. Here, I would not like to be really disappointed from an ITC perspective because the ITC is almost 3/4 of the market. If you are that high market share, you can never grow faster than some of the smaller players if they are doing something different. So in Godfrey Phillips, if you see, it is not a pan-India player. They have become aggressive in the 10 rupee price point in terms of trade incentive, just like Campa Cola is doing a higher trade incentives. That is impacting other beverage companies. Similarly, Godfrey Phillips, which is, say, 1/5 the market share of ITC in cigarette, they have become aggressive in the 10 rupee price point, not at the customer level, at the dealer level, more incentive.
What's your target price very quickly on ITC? I mean, it's also market positioning, right? Stock hasn't done too much. What's your target price, Abneesh?
Yeah, we do expect almost 20% upside in the next 1 year. Maybe 2 months of time correction can be there. But yes, the worst is behind for ITC.
And that's the optimism I think the stock is reflecting today. Okay, very quickly, let's move to Colgate, which was quite a disappointment. But I think you still have a buy call on it, don't you, Abneesh?
Yes, because we remain positive on the new MD's interventions which she is doing. If you see, the market share loss is not there. Dabur saw -5% in oral care in Q4, while Colgate saw -2%. Our sense is two issues are there. A very high promotional intensity is there. Our sense is in Q2 that will start reducing. Second is urban slowdown at the lower end is impacting all FMCG companies. So that is the issue. Colgate is seeing very high growth in the premium, and in the rural also it is doing well. So our sense is from Q2, the recovery will start, and H2 you will see strong numbers from Colgate. So this is just a temporary blip of the urban slowdown and very high competitive intensity in the toothpaste, which will reverse.
Okay. All right, Abneesh, a quick short chat today, very focused on these two stocks, but quite helpful. Thank you so much for joining in with the quick notes over there on both ITC as well as Colgate. Now we're at about 9:05, so I'm just checking the pre-open rates. It's settled. Now the Nifty is actually up 25 points, in sync with how a lot of the other Asian markets are trading. So that's what we have. Sensex changes around the corner. Come June 23rd, we'll have two stocks moving out, two stocks coming in. Let's go over to Vivek to understand what the names are and more importantly, the flows impact. Vivek?
Well, good morning. Absolutely right. Well, it came as a bit of a surprise. The changes generally happen on a Friday. That's what they announced. But this time around, they were announced on Thursday evening itself. So this is the June 2025 reconstitution. As far as the Sensex is concerned, adjustments will take place on the trading session of 20th June, effective 23rd June. So, which are the two inclusions? Trent as well as Bharat Electronics enter the Sensex. As per IIFL Capital, Trent will see inflows of a little over $300 million and Bharat Electronics will see inflows of over $350 million. On the other hand, what makes way? Nestle. Nestle will exit and expect to see outflows of close to $220 million. And IndusInd Bank, that also will exit the Sensex, will see outflows of close to $130 million. Expect some reaction on all of these stocks in today's trading session.
Vivek, thank you very much for that. Sid, any implications of these changes, in your opinion? And more on which of these names?
Yeah, because I think, so if you look at, definitely, if you look, both of these spaces are doing well, especially if you look at the defense space. For the first time, we'll have a dedicated or a focused defense company in a benchmark index. So that goes on to show that how the sectoral mix is changing in the large caps for India. So definitely a big positive move for the entire defense space, not only for BEL, getting it included in the Sensex. And I think the structural story continues to be very positive, and we remain positive on defense. Trend, I think, yes, some sluggishness in number, but overall long term we remain very positive. We see that again, aggressive growth plans across its segments, consistent growth, same store sales growth did slow down in the previous few quarters, but again we believe that there is a huge potential, long growth runway, and with the store expansion, they're all set to achieve the high growth numbers set out going forward. So positive on both BEL as well as Trend from here on.
I think the pre-open has ended and is mixed basically. Sid, thank you very much. Good speaking with you here on CNBC TV 18 this morning. So not directionless actually, like overnight Wall Street. If you look at what the Nifty and the Sensex have ended at the end of the pre-open session. Now, the RBI board is scheduled today to review their FY25 balance sheet and to decide on the dividend payout to the Government of India. A huge interest here. Sapna is joining in with details. Sapna, put this in context for us.
Hi, Prashant. So, yes, street expectations are extremely aggressive on this year's dividend. So, the estimate that's doing the rounds is anywhere from 2.5 lakh crore to 3.5 lakh crores. Some of our colleagues are also indicating that maybe it could be around 4 lakh odd crores as per brokerage reports. However, we also need to look at two aspects. One, how much is it that the government has kind of estimated, factored in the money already? That's one. Second, also, what happens to the economic capital framework? Are there going to be material changes to that? Because RBI has already indicated last week that they have reviewed the framework. So the first point, of course, is that 2.56 lakh odd crore. It's a combined head inclusive of PSB dividends, FIs, and of course RBI dividends. So if you do all these subtractions and estimations, around 220, at least 220 to 225, I think is what government is factoring in. Anything over and above that is going to be the real boost to the exchequer, because this amount they have already factored in. If it's lower than this, then obviously the story is very different. then there could be questions raised on the RBI's balance sheet and, how their profitability has been over the past year. What are the headwinds that they have faced? That's one aspect. Second, and also the ECF thing. So both these things are what we have to watch out for. So in case it's anything above 2.5 lakh odd crore, that would not be a small boost. That would be pretty good. And this will have implications for the bond market as well, for the liquidity as well. There's a wide expectation that OMLs will start tapering off, and so much of liquidity will come in the banking system, which is what the RBI has been trying to ensure. And last but not the least, because of Operation Sindoor and the way the situation is on our borders, it could just be possible that maybe some request has been made to the Reserve Bank of India to make sure that some additionality is given.
Okay. All right, Sapna, thanks very much. We'll leave it on that note. Let's see what that final number indeed looks like and whether it is significantly above 2.5 lakh crore rupees. Let's go back to our technical experts with some final trading ideas and calls. Sudarshan, so 910, what's your call?
REC, I consider buying REC with a stop under 393.
Okay, so REC is a buy for Sudarshan today. Quickly revisiting some of the stocks. Let's go back to some of the consumer names. Metro Brands and Honasa. I think we've got Mangalam joining in. I'm just checking how they are in the pre-open. Metro Brands is actually up about 4%. Honasa is also not bad, about 3.5% higher. Mangalam.
The reason why both of them are higher in pre-open is because there are signs of improvement in these numbers. If you look at it, both stocks have corrected a bit from the highs, more for Honasa than Metro. And, the last 3 quarters, they've not shown much in terms of revenue growth. The fourth quarter, things seem to be turning around because of the strategic changes that the company has been undergoing over the last few quarters. So let's start with Metro. A 10% revenue growth that they've reported in the fourth quarter has led to margin expansion as well. The EBITDA margins have moved to 30% versus 27%. And going forward, they believe that margins are likely to improve because a lot of the Fila liquidation, the old inventory of Fila has been done, and they have newer vectors of growth in the form of Foot Locker, Fila, as well as New Era. On Honasa, the problem was revenue growth wasn't coming by, and the company had undergone an inventory liquidation with the distribution reset. Now we are seeing early signs of some recovery, 13% growth in their overall revenue, though we haven't seen an improvement in the margins. So operating leverage was something that the street was anticipating that hasn't come by, but good revenue growth is a start. More importantly, some of their core products in Mamaearth, which is about 70% of Mamaearth's portfolio, has grown in double digit in their key, channels. And the non-Mamaearth businesses, Dermaco has done about 100 crore in offline distribution, and all their newer brands have grown 30% as well, with an underlying volume growth of 21.2%, with increased presence in physical stores. So we'll watch out for how both these stocks perform in today's trading session. My sense, they should see some recovery from the lows.
All right, Mangalam, thanks a lot for that. We'll also be joined by the management later on, Metro Brands, in the next 20 minutes or so. For the time being, let's focus on Ramco Cements. It appears the street is extending the long handle and saying maybe the next quarter will be better because the numbers are very, very disappointing, but the outlook seems positive. If you take a look at what they reported in comparison to what we were expecting, the volume degrowth for me is the biggest worry. It's telling you that competition is ramping up out there because they've degrown and they've underperformed the industry, and this is after a while out there because they've been consistently outperforming the industry. That's what led to the top-down miss, revenue, EBITDA, as well as margins. The problem is the PAT as well did compress big time because of higher depreciation and higher finance cost. So that was the reason, because they've commissioned facilities as well. What's good, though, is that the net debt number from around 5,000 crores, it's come down to sub 4,500 crores. And they had promised the market that they will sell their non-core assets amounting to around 1,000 crores. Almost half of that, 460 crores, has been done. They're saying by July 2025, the remainder will be done. That will be good news, actually. But the outlook seems to be good from here on. And that's why the stock is getting away with just a 2% cut, because the prices have improved in the trade segment by 30 to 35 rupees and in the non-trade segment by around 60 to around 70 rupees. So here's the street is looking ahead, but the volume degrowth is something that is a little bit puzzling and a little bit disappointing on that front.
All right, Nigel, thanks very much for that. Market open coming up, just about 60 seconds to go, and then we will get going this morning. I don't think there's very much, at least large or directional on the Nifty, on the indices, and it's kind of flattish, slightly higher. Let's see if you're able to pick up on that. But this week the market's not done very much. As we sort of start to report on these Friday markets, remember the week ended last Friday was spectacular. So that's the backdrop. that we've got to see what happened this week in. So 24,600 on the Nifty, 24,630 on the Nifty. It's about 0.1% higher. The Nifty Bank is up about 0.9. Nothing. It's basically just about holding on with very, very, very small green change. 1,140 stocks are higher. It was very early to look at it, but for what it's worth. Mid-cap index is up 0.1. Small-cap index also will come up on your screen, and it'll give you a sense. Again, nothing. 2-point change. It's almost as good as unchanged this morning. Heat map on the Nifty, and then we'll get down to stocks. So it's largely in the green, so about some 7-8 names in the red, but bulk of it starting in the green this morning. Surabhi.
I would say Honasa very well spotted by Mangalam, because indeed, look at the stock, 9% higher. It seems that it's been an absolutely bombed out stock. So perhaps the market saying that, is this a sign of things turning? That's definitely catching the eye, probably the stock of the morning. But let's talk about the Nifty now. Nifty is very, very quiet. The newsmakers here on earnings, ITC is also up, like Abneesh was telling us. Even here, the market's taking a view that the worst of this palm oil inflation is probably behind, so the FMCG business should pick up. And cigarettes is holding steady, so 1% up on ITC. Sun Pharma is a disappointment. US business lower, specialty business revenues lower than expected, cautious commentary, talking about even the revenue guidance for FY26 is lower than what they typically put out for previous years. Sun Pharma is a result casualty. Reddy's is actually lower. Cipla is too. So all of pharma is starting lower. Other than that, Mahindra & Mahindra, ONGC, ICICI Bank, these are the other stocks on the lower side. Maruti Suzuki also on the lower end of the screen. So let's see what's working. Grasim is responding well after the fourth quarter print, 2% higher over there. ITC I've mentioned. Trent and BEL, both of these stocks, by the way, make an entry into the Sensex, remember. They're up and about today, 1.5% to about 1% up on these names. Eternal, Adani Ports, Infosys, those are the kind of names. The Bank Nifty is absolutely undecided. SBI is on the higher side. ICICI is negative. And HDFC Bank is also completely flat, not getting any directional cues. Reliance, your big names like Reliance, about 0.25% up. TCS, it's absolutely, indecision is pretty much the story today. Nigel, but Sun Pharma, from the large cap space, Sun Pharma is still down 4%.
Well, that's right. And the reason that Grasim is up is because the street seems to be saying, okay, the VSF business, which is the fiber business and the chemicals business, is not doing too well. But at least the losses in the new business, which is the paints, as well as the B2B e-commerce business, out there the losses have come down from around 350 crores to around 315 crores. So they seem to be liking that. But otherwise, plenty of stocks actually from the broader markets that are moving around. Power Mech, good set of numbers. Stock is flying away. Just pull up the intraday chart out there. The stock is doing very, very well. HPL Electric, another stock that's bursting away actually. The sales have come in higher by close to around 15%, and there's strong margin expansion. So big move is what we're seeing out there. Centum Electronics, that's another one. I think that's up close to around, 12-13% or thereabouts. So big move out there. A few stocks actually are building on to gains that we saw yesterday as well. So you have Emcure Pharma, stock is now up close to 10%. You have Cosmo First, that one as well is up and about in today's trading session. And remember, these stocks, they did well even towards the end of yesterday's trading session. So solid move is what we're seeing on a couple of these names. Pull out Reliance Infra as well. I think they had organized, they had announced a tie-up with one of the leading companies globally. And that one, in fact, was moving yesterday as well with high volumes. For the time being, more or less flattish as we speak. So flattish start with a mild negative bias in the broader markets, guys.
Absolutely. 1,300 stocks are lower and about 800 stocks are higher at this point in time. Vari Energy is down 6%. It's the number one volume-led sort of loser on the NSE right now. So 28.24 on Vari. Look at the volumes. Over 500,000 shares already traded. BSE has undergone a corporate event, I think, right? So 23.53 on BSE. That's Bombay Stock Exchange. There you go. So that is Bombay Stock Exchange. Sun Pharma is down 4.5%. I'm not sure if there is any news flow here.
Yeah, Sun Pharma is on earnings. Earnings being very patchy, especially the US business, the global specialty business, all of it has been below expectations.
So 5% lower here on Sun Pharma. Premier Explosives, 10%. I think we highlighted that, but it basically had a one-way kind of a move. And from 350, in about 10 days, it went up to about, almost $600. So 550 on that one. Coming off a little bit. Container Corporation, you'll hear from the management, is down about 2.5%, 2.6%. GMR Airport, again, numbers 2.5% lower. This Premier Energy, 3% as a solar company, 3% down, 1,052. Deepak Fertilizer, you just heard from the management, is down about 2%, 1,335, and so on and so forth. But, you know, there's more, but volumes are kind of lacking beyond that. On the upside, I mean, I think like yesterday, the number one volume-led gainer is Garden Reach Shipbuilders. Garden Reach is up another 3.5% after yesterday's near 12% move that we saw. So 28.65 on Garden Reach is what you've got going. It's an all-time high on that one. Power Mesh, I don't know if you highlighted.
Yes.
11% on that one. Honasa, I think we did highlight 12%. Trent is another one. JBM Auto is up about 6%. HPL Electric is up 14%. It's got large volumes, so 553. And Cosmo First is another one. Cosmo First was up 20%, limit up by close yesterday. It's a bombed out name, but this morning after yesterday's 20, it's up another 12%. That also reported numbers recently, 2-3 days back. So, you know, that's again coming up very, very sharply. So that's, you know, some of what is moving as far as the market open is concerned. Mahesh Patil is now with us. He's CIO, Aditya Birla Sun Life Asset Management Company, with what he's making of things. Mahesh, thank you very much for your time. Good to have you here. You know, before we get to markets, let's just address the one situation, which is with regards to IndusInd. As a fund manager, Mahesh, what's your sense? How do you think about this, basically? I'm not asking for a view on IndusInd per se, but do you think after what it has gone through, you know, someone credible at the top will be able to quickly, you know, correct things and get the bank back on growth trajectory as many are hoping to, or this is now going to be more prolonged? Just your thinking on a situation like this.
Yeah, good morning, Prashant. So I think in the banks, I think the most important thing is the two important things. One is on the asset quality side, okay, which is of paramount important, and second is in terms of the solvency. So if you look at it in a bank, okay, it could have some issues on the asset quality side. It could be temporary, it could be cyclical in nature. And as long as the bank's balance sheet is decent enough, the capital adequacy ratio, in spite of taking the losses, okay, which needs to be taken, is good enough. I think there is, I mean, obviously the stock would react, okay, to this thing, but finally, I think there is no really run on the deposits. I mean, that's another important thing, okay, which needs to be looked at. Retail depositors, what is the confidence? As long as the overall capital adequacy is still fine after taking over the losses, and the deposit side, okay, they're able to hold on depositors. I think if there is a change in management and leadership, okay, that becomes again for investors to look at it afresh and see what the new leadership has in store in terms of taking the bank, okay, to the next level. What are their plans in terms of stabilizing, first in terms of the asset quality issues, but also more in terms of the growth path, which are the areas they would try to look at, and what will drive the ROAs of the bank to a reasonable level. I think these are the factors, I think, which one would look at, especially whenever a bank or any other financial services company goes through a kind of a crisis situation.
Mm-hmm. Absolutely, and let's see what finally comes out of it and how quickly they can get the house back in order. Mahesh, morning, great to have you on the show. So I want to talk to you about the one sector, actually the only sector that's managed to stand out in the last 2 odd weeks, and that's defense. And therefore also, I mean, even I was looking at the tally for this week. Actually, defense is the only sector, the Nifty Defense Index is the only one that's up about 1 to 2%. Otherwise, the market's not finding too many legs to run on. Is that a concern on the overall scheme of things? I mean, the fact that this up move beyond 24,000 is becoming narrower and narrower. And beyond defense itself, what would your advice be, given the way the stocks have already run up now? Is it, is it becoming a little too hot to handle, perhaps?
Yeah, so if you look at the defense sector a year back, okay, or prior to that, we saw a huge amount of rally in the sector in anticipation of, good order inflow coming into the sector. And there was a focus on the government in terms of sourcing more from domestically, which led to the initial leg of rally. And the stocks really went very high valuation soon. And then we've seen a correction in the last 9 months. Since June, July, we've seen a correction in defense stocks and also PSU stocks in general. And post that, I think we've seen, again, if you look at PSU as a basket, right, because most of the defense stocks are in the PSU basket. PSUs are also started to now kind of do well. In some of the cases, the valuations were looking good. But defense in particular has seen a new lease of life, again, coming back on the recent conflict, what we saw between India and Pakistan, but also kind of realizing that India needs to secure its defense resources, okay, and looking at the geopolitical risk. There is a feeling that allocation to defense, okay, which has been kind of over a period of time, we see as a percent of GDP, it is still fairly low. That could potentially see an increase in the subsequent budgets. But near term, I think clearly there is emergency procurement, okay, which is likely to be there, which can mean that you could see order inflows for a few companies, which could buoy them up. So I think. But
are the valuations? I mean, we understand that there's perhaps still significant ordering potential, but the valuations, Mahesh, what do you think of that?
So I think valuations, again, have been the same, but as long as, again, it boils down to each company in terms of the order pipeline. Sometimes we see in defense that it can be lumpy. So I think going back only from a short-term perspective in terms of the emergency procurement, I think that could be a misleading. But companies structurally which have got a long runway and have got larger projects or strategic projects, okay, which can see continuous investments. I think in those companies, I think the multiples could probably be better than what it was in the last, say, 1 year or so, because the visibility there is now better. But I would say that's stock specific. I think it has to be looked into it. And while when there is a broad macro theme, everything moves up. But I think there is a credible story, I think, which is there from at least from a ordering side and a more long-term sustainability in the sector.
Okay, all right. Hi, Mahesh. Good morning. Good to see you in. What about the entire renewable energy space? How interested are you out there? You know, because there's plenty of uncertainty. It was a fancied sector just around 18 to 24 months ago. And now suddenly some of these stocks, they seem to be out of favor. And you have some unfavorable news every now and then. Waaree, for example, overnight what's happened with regard to the passing of the bill in the United States. That one's pulled back, though the numbers and the outlook that the company is giving is very, very strong. So from this pack, what do you like?
So the renewable space, one is the utilities or the power producers. I think those are the companies where their valuations had moved up earlier. I think we have seen a correction over there. I think that's a space which looks now more reasonable in that sense. The equipment guys, the suppliers, whether it is the suppliers of the panels or the cells, they have seen a large improvement in the order book, but more importantly in the margins because of the, mainly the export orders and some amount of demand supply mismatch which was there. I think our concern there has been that while the near-term outlook is good, profitability is very, very strong, there's a lot of capacity which is coming up in this sector, right? Because of whenever you see large margins and good order, you see more players coming up. So in the next couple of years, you could see more capacity coming in the space. And also some of the tariff barriers, okay, which have been put on in China and the US is providing this opportunity to make supernormal profits. We think that could be at risk. So I think in these sectors, especially the equipment guys, we are a bit worried because there could be pressure on margins, okay, because these high margins and these high ROC seem to be unsustainable at this point in time.
Okay, so some caution there perhaps on some of the renewable energy stocks. Got that, Mahesh. Thank you very much. Good conversation as always. You have a good rest of the day and we look forward to connecting again soon. Thank you very much. Well, that's a view from Aditya Birla Sun Life AMC. Markets actually doing quite well, cruising along right now. 100 points higher. Nifty is up about 0.5%. Mid-cap index also up about 0.3%. So it's turning out to be a good Friday so far. Let's keep it with the corporate conversations then. The next company on our radar is Metro Brands. Now, the company reported a healthy revenue growth for the fourth quarter. EBITDA has also improved quite a bit. Let's talk about these trends and the outlook with Mr. Nissan Joseph, Chief Executive Officer at Metro Brands. Mr. Joseph, thank you very much for joining in. So really a good quarter. I think you've got 10% revenue growth. There's a significant margin improvement. Margin is up to over 30%, 30.7% EBITDA margin. So let's start by understanding the broad demand structure and trends, because while the fourth quarter has been looking good, if I look at the year as a whole, FY25, I mean, you had guided as much as 12 to 15% growth. Ultimately, the revenue growth was around, I think, 6-7%. How do you gauge demand sentiment, the mind of the consumer right now? And what do you see ahead in FY26? Is it, how will volumes do? Or will you have to eke out revenue growth with some pricing uptick? What's the sense?
Well, Surabhi, good morning, and thank you for having me. I think we were very pleased to see the upturn continue through Q4 of this year. You're right. When you look at the whole year consolidated, it's been a challenging year. We had a lot of absent wedding dates going back to Q1, Q2 that really set us back a little bit. We also had heat waves. We had the election distraction. So there were some headwinds to overcome through the first part of the year. The good news is on the second part of the year, we were able to recover it quite well. As you mentioned, we were up 6% on a consolidated basis by the end of the year. But more importantly, I think what we've shown is our ability to have great financial discipline through the year. Though it was a tough year, as you know, that we posted some very good growth that exceeded our revenue growth in EBITDA that exceeded our revenue growth. And, we came in at the 30% range. We always guided that we would be at the 30% range. While the overall top line growth wasn't what we wanted, I think the recovery was good and we're headed back.
But what now, sir? The question is, what now? You've done 10% revenue growth in the fourth quarter. Do you think you'll build on that in Q1, Q2? What's the kind of top-line expansion we should expect? If you can't give us visibility for the whole year, maybe for the first half, but essentially, is it going to be more volume-led or is it going to be pricing-led?
Well, I think it's going to be both a little bit. We're not raising prices significantly. So any growth you see is actually coming from volume growth in the business. And we're pretty pleased as to how that's trending. We remain committed that we'd get back to the 15% growth rate on an annualized CAGR basis. So I think we have all the indications that we should be headed to that direction. You don't always recover and jump right up to that number. But as you can tell, the indicators the last 2 quarters have been very positive.
Okay, all right. Hi, sir. Morning. Good to see you, Ben. So at least a double-digit growth is what we can work with, right?
I think the indications are all in place, Nigel, that we should be headed in that direction. Okay. But more importantly, I think the other numbers that are important to us is the EBITDA and the profit, which we're starting to trend back at the 15% mark, which is we guide to the mid-teens on PAT. And then, of course, the EBITDA, we guide to about the 30% range. And all those metrics are coming in line.
Okay. PAT margins at mid-teens, EBITDA margins at 30%. Got that. Give us a few more details then. What kind of store additions will you be looking at for this year? And if you could help us out with some commentary on e-commerce. That seems to be plateauing a little bit. I think it contributes close on 10-11% of your total mix. Where is that headed?
Yeah, so just talking about store growth, I think we continue to be open and aggressive on opening the right stores at the right profitability. We're not going to open stores for the sake of hitting a number. We're going to open stores as and when they make sense for our portfolio of different brands that we have. Our e-commerce business continues to do well. However, as we all know, you can drive a lot of growth in e-commerce if you want to be discount-led, which we don't want to be discount-led on e-commerce. For the year, e-commerce outpaced our regular growth. We were up 20% in our e-commerce business. So that remains healthy for us, and we like it because it's at a healthy pace that comes where it's brand enhancing, without destroying any brand salience at the same time, is a profitable business for us. So it's one of those balances that you have to do as you want to grow the e-commerce business. You have to decide where you want to lie with that e-commerce machine. And also, we've started exploring quick commerce, and like what all the press has been reading, we find it to be very polar in terms of to the big cities and not as much in the smaller cities. So we continue to explore that as well.
Mr. Joseph, hi. Good morning. So online is about 8%. That channel is about 8% for you?
It's a little north of 10% for us.
Okay, a little north of 10%. Now, in the past, we've spoken about premiumization, right, across the board. Is that happening? Because if I look at, price-wise sales mix on a quarter-on-quarter basis, maybe quarter-on-quarter is just too... the data is jerky, but over 3,000 rupee products is about 54% sales mix. It was 56% the last year. It's broadly been between 52 and 54 odd % or so. Could you give us some idea about this? How this is likely to trend up?
Sure. We continue to see the premiumization trend. But what you're saying, and you rightly pointed out, Prashant, is the fact that Q4 is our end-of-season sale quarter, right? And that's when we use that period of time to clean out any old goods that we have, end-of-season lines. And that typically mutes your ASPs, right? So what you're seeing, that 2% delta, is really more of a reflection of the business and the cyclical nature of the business, as opposed to anything that's showing a premiumization trend fading off.
Mr. Joseph, can you tell us a little more about the Foot Locker expansion this year? What are you expecting from some of these additions? Fila as well. When does Fila break even? How much will it add to your top line? Some sense from these brands.
Great. So, Surbhi, let me take that one at a time. When you talk about Foot Locker, I must be honest and say that the BIS rules that came in has been a little bit of a deceleration of our growth. We would love to grow more Foot Locker stores, but we wanted to make sure that our brands, our suppliers had settled into the BIS supply chain, which is all new to a lot of people. Now that that's behind us, we will continue to open a few more stores this year. And as we overcome the BIS issues and the factories get certified and or up to speed, we should continue to see that Foot Locker acceleration into the next calendar year as well. On the Fila front, I'm very relieved finally that we have gotten out of cleaning up all the inventory for Fila, and we hope to start the journey of opening stores for Fila later on this year.
Okay, all right.
So in just in terms of break-even timelines, the losses have been coming down. What about break-even and overall contribution from Fila? Can you give us some sense of what you are expecting this year?
Sure. Yeah, it's not a question of contribution, because what we've always said was we're going to take the first couple of years to clean up the brand, number one. Number two, the second phase, which we're in right now, is to reposition the brand. So when you move to repositioning a brand, it is not about a % of sales. It's about, are you pulling the right levers? Are the right assortments coming into stores? Are they selling well? And we've started launching Fila into our Metro and Mochi stores, and we're starting to see the green shoots come there as we anticipated on the year where we reset the brand, right? So that's going on track. And now we also, the next phase would be to start accelerating the opening of stores, and then also accelerating the amount of Fila that we carry in our Metro Mochi stores as well.
Okay, all right. Just a quick question with regard to Fila, Foot Locker, as well as New Era. How much do they contribute as a percentage of your revenue mix? And say in the next 3 years, how much do they contribute?
Yeah, so I think today that contribution is extremely low, right? It'll be single digits. I think you will see that accelerate simply because it's on a low base. From a growth standpoint, it'll be significant, but it's not like we're not growing our other banners as well, right? So we are growing Metro, Mochi, Crocs, and Walkway. We're growing all the banners. So it's not that it's going to jump up and become a double-digit contributor overnight, not because it would have been underperforming in our mix. It's just that the rest of the mix is not stagnant either.
Okay, all right. So a smaller contribution as of now. But, there's that buyout talk of by Dick's Sporting Goods of Foot Locker. Does it change things for you?
It really does not change anything for us in our arrangement and our commitment to growing the Foot Locker brand in India.
Got it. All right. So that's out of the way. And what about Fila? You didn't give us a definitive time by which when it turns around. Most of the inventory has got done, that we're sitting on in the third quarter itself. So when does that turn profitable?
It's not a question of timing it on turning around, Nigel. This is the year we reposition the brand, right? So it's a journey. It's not a milestone that you accomplish and say, okay, now we're done. It's a journey. It's going to be a constant journey to build that brand. It'll accelerate as we go through this year, and it'll pick up its own momentum at the pace that we anticipate it to.
Okay, if you could tell us, because you're promising more store rollouts now, both Foot Locker, Fila, etc. I just want to understand how much money you'll need to put to work as you open more of these stores.
Yeah, so the capex is not cheap, as you know, but the good news is, fortunately for us, we have a significant war chest when it comes to cash at hand and cash to invest in growing our business. So that is not the concern. We're more concerned about getting the right locations that sets up the brand to be successful in India at the right metrics financially to ensure that it's not dilutive.
No, we just need to understand, absolutely, sir, full confidence in your capabilities and your team's capabilities. Just need to understand that from your cash, what is the total cash level right now? how much is going to be deployed towards these store openings? And then perhaps subsequent quarters, we'll talk about the break-even timelines for those new stores. But just some sense.
Yeah, so, we have a sizable war chest. The number changes every day, but it is in the hundreds of crores that we have at cash at bank. So that's not the issue. And as far as it being a significant dent to that, it's not going to be a significant dent to that, as you can do. A store would take anywhere between 2 to 3 crores to open up between the fit outs and the inventory costs. So, it's not a significant factor that we say, what's it going to do to our cash at bank? And, we continue to generate free cash flow as we go through every quarter.
But how many stores will you open this year? We didn't get that number.
No, and it's because, we're not fixated on opening the number of stores. What we're really fixated on is opening the right stores at the right prices. So we'll open as many stores as we can find in the country with the real estate. As you know, the real estate rents have been rising. So now
I think last year you opened 70. This year, will it be as many, fewer, or more?
It should be more.
It should be more. Got it. At least we got some color on that. And final question, ad spends as a percentage of sales, what is it at? And since you're going to be driving growth, where does this number head to?
Yeah, so right now it runs about 3 to 4% in our company. And I think that's a very good question, because I think the time has come for us to take a look at that and see how do we invest in the marketing, in the ad spends, to ensure that we continue to solidify our existing brands and also build the brands that we've recently acquired.
Just last question, Mr. Joseph. These 3 brands which my colleagues were asking about, these shoes are made where? They're made in India? They're made outside India?
It's a mixture of where they're produced. So if they're produced outside of India, they're produced at BIS certified factories. But a majority of that is being produced locally now.
More than 50% of these are being made here locally in India.
50% of Fila and Foot Locker combined, yes.
Got it. Thank you very much for joining us. Good speaking with you, and good luck with your business as we look ahead. Thanks very much. That's Metro Brands. Stocks up about 3% or so. Now, PI Industries also reported numbers. Well-watched company, has been a long-term wealth generator. Fourth quarter, though, was a little tough. And more importantly, the guidance has been a little muted as well. We have Mr. Mayank Singhal, Vice Chairman and Managing Director at the company, now joining us on the phone line. Mayank, good morning. Great to have you with us here. Prashant, this side. Could you, I just want to start with that conservative guidance for FY26, single-digit revenue growth guidance. Could you give us the construct behind that guidance? What are you seeing out there in the market across your segments?
Yeah, good morning. Thank you for having me. I think just if you look at the industry over the last couple of years, the overall agchem industry has been on a negative growth rate. If you look at all the large big companies, including last year, the top 20 companies all were in the negative. PI was the only company in the top 20 companies which had a double-digit 19% odd growth. So if you look, PI is already starting at a high base, followed with this year where industry was to see a certain turnaround. But once again, there have been strong headwinds, both coming from the agroclimatical situations and crop pricing, and now certain other issues around tariff. Given that scenario, we do believe that the coming year, again, the industry overall is not looking to grow aggressively, but we definitely see positive shoots coming out in the H2 part of the year. So if you look at PI, we have taken that guidance based on the high base, based on the continued 2 years of challenges the industry has seen and is expected to see going forward. But if things turn better, we expect to do better.
No, absolutely, and maybe it'll come through the push, perhaps the revival, etc., comes in the second half, as you said. But if it does not, is it possible, Mr. Singhal, that we actually see flattish growth, no growth, even slightly lower growth compared to what you've done in 25?
Well, let me be honest, it's too early to comment on that, because at the end of the day, industry dynamics do have an important role, specifically if you're playing at a scale and size that we are as a part of the industry value chain. Yeah.
So it's possible. It depends, right?
It's possible. It could be possible on the positive side, it could be possible on the negative side, to be very honest, right?
What about margins, Mr. Singhal, if you can give us a sense?
As you would see, we've already given a guidance of a margin, and we would continue to be able to manage the margins if we put that out, given looking at the dynamics of the industry.
Okay. All right. Hi, Mr. Singhal. Good morning. Good to see you. Nigel on this side. One bright spot last year was new products, and the contribution, I think, went to high teens. How much can it contribute to the overall agrochemical CSM exports? Last year, I think it grew on a lower base by close to around 30%. So for this year, what are you factoring in?
Well, looking at that, we continue to continue to grow that at the same pace rate. And obviously, as you know, the new products as they come in, they have their own time cycle of ramping up. And if the industry cycles pick up, they tend to ramp up faster, so that ratios could change for the better.
Okay, all right. So that number then could head, if it's going to be growing at a faster pace than the overall business. So, the new products could contribute close to around 20%, say, in the next 2 years?
Yes, that's what we anticipate, somewhere around there.
All right, great. Let's talk about the smaller part of your business then, the pharma revenue. That's perked up to around, I think, 85 crores or thereabouts. It's not making too much of money. For the year, I think you did close to around 220 crores of revenues from the pharma business. For this year, what kind of a number are you working with in terms of a growth?
If we look at the pharma business, as you know, we've acquired these couple of assets and capabilities. And as you would have seen, we've acquired a great leadership team, which we're building up across the world. Given the biotech environment and looking at where we stand, we are expecting that this could be the year where we start seeing some green shoots. We've been able to acquire some interesting customer bases, and I'm sure, been confident that we'll be able to give a good growth rate for this business, at least in the 30 plus 40% areas.
I think the growth for the pharma business is much more, right, for this year in the near term?
Yes.
F26, you're guiding for a 75% growth?
Yeah, that's right.
And at what revenue scales then will this start turning profitable? Because back on the envelope suggests that for this year, you'll be closer to around 400 crores, maybe 370 crores or thereabouts. At what revenue number does it turn profitable?
We believe in the next couple of years, it will start showing positivity, and that's where we are.
Ballpark 500 crores?
Yeah.
Does it turn profitable?
Yeah, that's right.
Mr. Singhal, in pharma, do you expect a significant improvement in margins going forward?
Well, there are two parts of the pharma business right now. Yes, if I look at the contribution margins are pretty good and will improve there, but at the same time, we are investing heavily in building capabilities and resources to scale this up. So, it's a hockey stick issue right now. In the beginning, as P has always done, in the past, if you look at a contract manufacturing business, 8-10 years, we've constantly been investing. And when scale hits, then we are able to actually take that aggressive growth rate. So for that, the front-end investment in system, process, people, infrastructure is what's going to be putting that challenge for now in the short term. But I'm pretty confident in the next 2-3 years, you will see that effect coming up.
But the focus is going to be contract research, contract research, development, manufacturing. I mean, that's essentially the thrust of the pharma business from here on?
Well, it's a part of the CRDMO play. It's just not the contract research and manufacturing, which is in the pharma world, yeah. But where we are leveraging our strong capability in science and chemistry and scientific knowledge.
What about biologicals, Mr. Singhal, if you can give us a sense of, I think that's about 20% of your revenues in FY25. Again, here you're expecting better growth going forward.
Biological has been always a passion, is a part of our purpose, of putting a reimagining healthier planet. And as we believe today, going further in the ag space, agrochemicals and biologicals are going to go hand in hand. We've been not in biologicals as of today, but we've been doing biologicals over 25 years. We believe we'll be the leading company in biologicals in India in the very near future. As a part of this strategy, our passion for biologicals, we recently, as you know well, last year acquired Plant Healthcare. Plant Healthcare has got a unique platform technology based on which we are looking to take biologicals to the world, with having setups and distribution partnerships across the world in the US, Mexico, Brazil, and certainly in Europe, and further expanding that back and bringing these products and innovations into India. So we do believe biological is going to be one of our front runners, and we expect to see good growth coming from it. As you would have seen over the last 3 years, we've put our focuses on it in India. We've been doing more than a 25% plus CAGR growth, and continued on this pace, if not more, at a global rate, we would be able to put a differentiated capability in the biologicals at a world platform.
Any inorganic growth we should brace for this year?
Well, as you know, the balance sheet of the company is strong. We're sitting with surplus cash. Anything that is complementary, given the environment in the areas of our focus, and can create scientific and scalability and leveraging our existing capabilities would be, which are opportunities we're constantly evaluating.
So you're on the prowl?
Always looking. Nothing wrong with that.
Should we hear about something in this fiscal since you're looking?
Well, I don't know whether I can say that, but I'm always looking for the fiscal or whether there's what, but we will always look for what is right.
All right, Mr. Singhal, good speaking to you. Thanks a lot for joining in. Looking forward to chatting up with you more often. Well, for the time being, we'll slip into a short break, but on the other side, we have Sanjay Swarup of Concord, who's waiting to detail their quarter four numbers. Welcome back. Well, markets are booming away as we speak. We're at the high point of the day. Big moves is what we are seeing, in the markets, and the broader markets as well have seen a good recovery. And I'll tell you what, one positive today is, as I highlighted earlier, we would like to make a higher high. And that seems to be the case today. The last few trading sessions, we've been making lower highs. So that's one positive on the Nifty itself. But as promised, Container Corporation of India, that's the stock on our radar. They've reported actually a very muted performance. Even the past year's performance was rather muted. To discuss what went on, what's the way ahead, we're joined by Mr. Sanjay Swarup, the chairman and the MD at Concord. Hi, Mr. Swarup. Good morning and good to see you in, sir. First, let's focus on volumes. Could you give us the realistic EXIM as well as domestic volume growth target that you have for FY26? I ask you this in the backdrop that last year, well, you're guided for high teens. You ended up with high single digits. So realistically, what can you guide for this year?
Yeah, good morning. Actually, we are having a very good demand in this financial year. We see very stable volumes in EXIM, imports as well as exports. And similarly in domestic also, there is a very good demand, and especially in bulk cement, and then rice is there. And tiles traffic, we are having a very good demand. And apart from that, food grains are also there in domestic. So we have worked out the forecast for this year, and I will like to give a guidance of 10% growth in EXIM and 20% growth in domestic. That will be total growth of 13% for overall for the company. And this is a very robust demand. And seeing all these demands and how to meet with these demands, we have embarked on a very good capex also for this financial year. Last year we have spent rupees 810 crores on capex. This year we will be spending rupees 860 crores actually on capex, and maybe mid-year we will have a review and we will scale up also.
Okay.
Primarily, this will be used for purchasing of new containers and new container rakes and setting up of new terminals. So we are giving a big infrastructure push for the company.
Got it. Okay. All right. Just focusing on volumes then, sir, what is your market share according to your expectations? And also, the hope was that the DCF connections at Mundra, that would jack up volumes. Why is that not happening?
See, DFC connection to Mundra is definitely giving us good volumes. And now in this financial year, we are expecting that even Nhava Sheva will also be connected on DFC by December 2025. Of course, we will feel the impact only in Q4 of this financial year. And we see a very good volume growth on Nhava Sheva stream also. Mundra, of course, is giving us very good volume growth. And we have been able to divert lot of traffic from road to rail as a result of the timetable trains that we are running from our MMLP at Dadri to Mundra.
Okay. And your market share?
Our market share actually on a pan-India basis, if you see, it will be around 58 to 60%. And one thing I want to add is we have gained the market share without sacrificing our margins. We have been consistently able to maintain EBITDA level of 24 to 25%, which is very good in logistics field, because normally in logistics it is in single digit.
All right,
so despite maintaining the EBITDA, yeah, we are able to give increase the market share.
All right, sir. So you'll be able to maintain your margins at these levels, right?
Yes, we will be able to maintain our margins also, and we will increase our market share, as well as I am very sure that we will be able to achieve the guidance of overall 13% growth in this financial year.
Okay, all right. But, realizations, they came in at multi-quarter lows in the second half of the year. What is causing this kind of unusual pricing pressure?
No, actually, I will not call it a pricing pressure. It was not a pricing pressure. It was a strategic decision for the company to pick up some traffic volumes. And now we are okay. And if you see the overall EBITDA margins of the company, you will be seeing that for the financial year, we are quite close to 24-25% that we have been there for so many years. So there is no pricing pressure on us. And we are, serving the niche segments, and we have a tie-up with big corporate houses. So there is no pricing pressure on us, frankly speaking. Basically, we get our customers, we get our volumes based on our service levels. We give a lot of emphasis on service levels, and that is appreciated by our customers.
Mr. Swaroop, sir, overall question on this long-awaited completion of the dedicated freight corridor. I think there's some reports indicating that maybe the western arm could be completed ahead of schedule. Maybe we see some traction in October. Just give us your estimates on how much of a boost will railway get once the DFC is fully operational, and more importantly for you, can you give us some sense of volumes, the implications for your business if the western arm, at least of the DFC, gets commissioned ahead of schedule in October this year?
See, officially we have been told that Western DFC will be commissioned up to Nhava Sheva. That will be completed by December 2025. So I have been reading some media reports that it may be completed ahead of schedule, but that will be a welcome sign for us. And we are fully geared up. We already have our 4 depots on Western DFC. 5th one is coming up near Ahmedabad. So all in all, we will have 5 depots on Western DFC, and we are fully prepared to cater to the increased traffic that we are expecting in Western DFC. If to answer the second part of your question, when the Western DFC is commissioned, we cannot expect that overnight there will be a spurt in traffic. It will take at least 1.5 years to stabilize, and I am pretty sure that the rail coefficient at JNPT, which is at present below 20%, within a span of 1.5 years of commissioning of Western DFC, it will double.
So, sir, okay, I mean, give or take, whether it's October commissioning or December, we'll see. But give us some sense of projections. I mean, how will your volumes change in calendar year 26? Or let's say FY27 would be perhaps a better measure. Once the Western DFC stabilizes, as you're saying, what's a numerical implication that your investors can look forward to?
See, this year I'm giving guidance of 10% in growth in EXIM. Maybe next year, if I give guidance for FY27, maybe this 10% may become in the range of 17 to 18%. That is the rough estimate I can give you.
Okay. All right, Mr. Swaroop, a couple of more factors that I want to clear out. What is the LLF that is expected in FY26? And what's the status with regard to the disputes with Indian Railways?
I would like to clarify, there is absolutely no dispute with Indian Railways. It is our administrative ministry. We are working under Indian Railways. There is absolutely no dispute at all. Okay. And secondly, as far as the LLF is concerned, it is fully sorted out, and whatever LLF we have been paying every year, it will be around same level, because there is growth of LLF by 7% every year as per the formula. But at the same time, the land which we are not using, we are surrendering back to railways. So we will be maintaining around the same level. LLF number will be around the same level.
Okay, all right. Final question. We cannot let you go without asking you this. Since you're guiding for better times ahead, Mr. Swaroop, is a divestment on the corner? Because that was a big trigger from a stock market perspective.
I cannot answer the...
Have you heard about anything, sir? Any communication has come?
That is a policy of Government of India, and whatever directives we get, we have to follow that. I can only tell you this much.
Okay. All right, Mr. Swaroop, we'll leave it on that note. Thank you very much for joining us and giving us a sense on how the business is progressing. FY26 should be better than 25 and 27 maybe even better once the western arm of the dedicated freight corridor is commissioned. Well, that's Concor. Back to the markets, and markets are cruising along nice and steady, almost a 200-point rally on the Nifty. So it's turning out to be a really good Friday morning. There we go. And lots of mid-caps also bouncing around 0.5% up on the mid-cap index. Let's put the spotlight on some news. Ekta is tracking Sun Pharma. While the market's doing really well, it's not been such a great morning for Sun Pharma because of the fourth quarter performance and the commentary going forward. Ekta, tell us why is the market a little disenchanted with Sun this time?
Well, yes, definitely. It's besides the numbers, that's what the street is disenchanted with. So, for example, they are looking to invest $100 million in terms of additional costs on their specialty products. Plus, their R&D expenditure is going to go up to around 6 to 8% of sales. The FY26 guidance is around mid to high single-digit top-line consolidated growth. This is versus earlier years of around high to low double-digit growth that they've generally guided for, high single-digit to low double-digit growth. And they have mentioned that it is because of the uncertain environment that they're facing on the regulatory front, on tariffs. So as of now, they don't have clarity. Besides that, no EBITDA guidance which has come through. So there is uncertainty which is, on all fronts except for especially for the guidance. Now, if you look at the geographies as well, US sales $464 million, Street was anticipating over $500 million. Global specialty sales in Q4 were $291 million. There were some estimates of over $300 million, $310, $315 million. So that's the reason why there is some amount of disappointment which has taken place in terms of the numbers. Otherwise, in terms of the operational performance, it was an in-line quarter for Sun Pharma.
Okay, all right. Thanks very much for that, Ekta. So that explains the negative 3% move on Sun today. But back to stocks that are on winning ways, and Power Mech is definitely one of them. Stock's been up almost 12, 13%. Yeah, 12% right now, as we're seeing it. This on the back of what looks like a very solid fourth quarter. Vivek is back. Vivek, remind us about the numbers and the performance.
Well, that's right. What we have to keep in mind is as far as most of the infra companies were concerned, remember H1 was very muted in terms of execution. So despite a good order book, a lot of the companies face significant execution challenges on account of lack of labor as well as the election-related disruption. But what's actually transpired is that most of the infra companies, as far as H2 is concerned, especially in Q4, have managed to end the year on a very strong note, especially when it comes to execution. So when it comes to Power Mech projects, look at the numbers. Revenues in this particular quarter higher by 42.5% on a year-on-year basis, a little over the 1,850 crore mark. The EBITDA higher by over 44.2%. Cost of materials, despite going higher, has been more than offset by the operational efficiencies that the company has shown. EBITDA margins on a year-on-year basis up 10 basis points. That should be seen quite positively, and profitability higher by over 52%. On a year-on-year basis, again, profitability higher by 42%. Remember, the company is sitting on a very strong order book as well. One portion of the order book, remember, is from the MDO, which is the Mining Development Operating License as well that the company enjoys. So overall, it'll be interesting to see. We're still awaiting the investor presentation, but the order prospect pipeline as well as the order book at the end of Q4 is something that the street to watch out for. Overall, a good operational performance is leading to the stock up move.
Almost at a new high. After the short dip that we saw recently, Power Mech there. Vivek, thank you very much for that. 200 points now on the Nifty. And, this is the expiry got done yesterday. There are two things. One, of course, is the expiry itself. So that Thursday expiry, we've seen big swings, market yanked up, yanked down. Yesterday was down. It's a bit of a cleaner run. The second is this is also the week before the monthly expiry, which is next week. And, the week before usually typically tends to be a little subdued. There is also some correction, etc. At least that's been history. And then the market finds a bit of a trend, the original trend, which has been on the way up. Is that essentially what is happening? I think one needs to see. But it's very, very strong gains now. So 24,800 is back on the table after yesterday, intraday, the market breaking the 20-day moving average. So this is looking very good. We have Vinay Rajani, Senior Technical and Derivative Analyst at HDFC Securities, now joining us. Vinay, good to have you here. Thank you for your time. So what's the trade here, if any, on the indices and then specific stocks?
Yeah, good morning. So Nifty found support at 20 days EMA. Yesterday we saw a nice recovery from the lower level post 2 p.m. and today it is continuing today almost 200 points rise in the Nifty from the lower level. So a nice recovery, nice sector rotation is going on. I think the bias is positive. However, 25,000 is a very strong resistance. So overall we are into the range of 24,500 to 25,000 range. So till that range holds, we can say that markets are into consolidation, but the primary trend is clearly positive. Once we see Nifty crossing 25,000 on the upside, then immediately we can see 400, 500 points upside. So stock specific, sector specific, there are many opportunities that one should trade. Nifty, no doubt today it has already registered a recovery of 200 points, but one should look at the stocks rather than Nifty index. So IT is the index which looks very promising to me. So after consolidation, it has given fresh breakout. So there are opportunities in the IT stocks. One can concentrate and generate some alpha in the trading.
Any specific names here?
Yeah, so Coforge is one of the stock which we like from the IT space. It is one of the strongest stock from the IT space. So Coforge can be bought around 8445. Stop loss can be kept at 8300. On the upside, I'm expecting a target of 8650 in next couple of sessions. The second sector which we like is the real estate space. So Oberoi Realty has just surpassed the crucial resistances and looks very promising on the charts. So Oberoi Realty can be bought at 1735. I would suggest a trading stop loss at 1700. On the upside, I'm expecting a target of 1790 in next couple of sessions. So Oberoi Realty and Coforge would be my trading bets.
Okay, all right, got that. Vinay, thank you very much for being with us. So those are some of the trading calls of the hour. Let's move on and get you something from the auto space now. It's quite exciting for those who are looking to buy perhaps, a new hatchback. These days, the new hatches are few and far in between in the Indian market. Tata Motors launched the new Altroz hatchback, and this at a price point of 6.89 lakh rupees ex-showroom. This is the first major upgrade that the premium hatch has received since it was launched by the company, Tata Motors that is, in 2020. We caught up with the MD of the company, Shailesh Chandra, who believes that premium hatchbacks will drive growth for Tata Motors in FY26.
The players who had exposure to both SUVs as well as hatches pretty much mimicked the slowdown in the industry. But SUV-heavy players did see the benefit given the growth rate that we were seeing in the SUV segment. Hatches, which declined by 13% in the industry, our decline was more than 30% because of the aging of two products that we have in the hatch segment, which was Tiago, which was also in the fifth year requiring a major intervention, and the Altroz. And we lost nearly 50 to 60,000 numbers as compared to FY24 because of the issue of aging and also the decline of hatches which we were seeing. But we launched the model year, intervention, and a new Tiago was launched in January 2025. And in Q4, we saw a significant jump in Tiago, coming back to the volume levels where it used to be. And now we have Altroz, where we had seen the significant decline, that also coming with a very strong refresh. Our refreshes are going to come in time. So there will be one refresh. You have already seen the new Altroz. There will be one or two more, which you can expect in this financial year. Then there is expansion of EV portfolio with Harrier and Sierra also coming in this financial year. Then you would have the ICE portfolio, which will come with a new nameplate, which is again Sierra ICE. So a lot of actions that you are going to see during the year. At an industry level, or, if you really see all the consumer-facing industries, there has been a bit of slowdown for last 1.5 years. And we see that trend right now, continuing. And therefore, at an industry level, we are seeing pretty much a similar kind of moderate growth as we had seen in FY25. Specifically talking about entry segment, and if you really see the hatches segment, which has been declining as far as the share of TIV is concerned. But within the hatch segment, if you really sub-segment the hatches into 4 parts, entry, mid, high, and premium, there's a gravitation towards the premium hatchback segment, and it is coming at the cost of significant decline in the entry hatch segment.
Okay, well, we'll take a quick commercial break here. Markets up 200 points on the Nifty. Lots of stock-specific action. Manisha will be with us with commodities in focus on the other side. Stay tuned.
Welcome back. Let's talk commodities now. Equities are, of course, having a good morning. We've got Manisha joining in to talk about the big headlines and the big cues. Manisha, so what's the main headline this Friday morning?
Well, I'm looking at natural gas prices, and that is because we've seen a very sharp correction onto this one. Remember, the first quarter of this year, the natural gas prices were just rising higher, and markets were looking at various kind of tariff impact on this. But overnight, we've seen natural gas prices decline by 3%. It's down 2% in a week. It's down 10% in 2025 till time. But when you look at the last 12 months, we still are trading in the positive, up by nearly 18% there. Well, also, when you look at the overall markets, it is about increase in supplies in the recent few months there. The markets have seen a strong build-up when it comes to US and sense of inventories there. So if you look at the build-up right now, it's at 120 billion cubic feet. 1 year average has been at 78 and a 5-year average at 87. So we are looking at inventories much higher than what has been a high long year average as well. So with this kind of a build-up, the total gas storage that stands in US right now is 3.9% higher than a 5-year average, which stands at around 2.3 trillion cubic feet right now. Also, when you look at the LNG exports, well, for the month of May and April, we've seen those numbers continue to gain up on the higher side. It was 16 billion cubic feet in the month of April, and May is looking at 15.1. So that in turn also seems to be weighing onto the markets. US LNG output, well, if you look at that, has been a record in the month of April. It is also a low demand season. But going forward, the street anticipates that you could be looking at demand coming back, especially as we are getting into Atlantic hurricane season. And then most of the countries will start increasing inventories ahead of that winter period season as well. So that could be supportive. This quarter, markets anticipate you could be looking at some more pressure coming in. Going forward, it also is about a future perfect because you are looking at natural gas demand very strongly coming in from artificial intelligence. It's projected that the demand will increase for powering data centers, which is 24/7. And that is, especially when it comes to US and Canada, European Union, natural gas is what is used for AI data centers. Global natural gas demand could surge by 50% by the end of decade is the view coming in from Australia Woodside Energy. They are the biggest when it comes to natural gas in Australia. Strong statements also coming in from IEA, which says that the AI-driven data centers will increase electricity consumption by 90 trillion watt hours, and much of this would come in from natural gas. So near term, well, cyclical bearishness, but structural bullishness could continue for natural gas prices.
All right, Manisha, thank you very much for that. So that's the commodity view. We'll take a quick commercial break here. We're going to put our focus on energy, renewable energy, and we'll talk about the challenges that the sector is facing, if any. The broad global kind of push, of course, has been that thermal is back, coal is back, or at least it wants to be. In that context, what are renewable efforts here in India looking like? Lots of listed options here as well. So we'll have Mr. Mohit Bhargava, former CEO of NTPC Green, Sumit Kishore of Axis Capital, talk to us about this. Stay tuned.
Welcome back. We're putting the spotlight on the power space, specifically India's drive to move towards non-fossil fuel sources of power, the whole renewable push. Mohit Bhargava, who is a senior advisor at the University of California, Berkeley, and of course, he's also been the former CEO of NTPC Green. He's with us, and we have Sumit Kishore, Executive Director at Axis Capital, to talk more about this. Gentlemen, thank you very much for joining in. If I could actually start with you, Mr. Bhargava. Now, our ambitious, dream of reaching 500 gigawatts of capacity on the renewable side, I think last count, some notes that I read, by the end of 2024, we were roughly at about 209, 210 gigawatts. Some argue that the pace of movement is slow. What are the major challenges? I mean, I was reading somewhere that apparently 40 gigawatts of capacity is stalled because PPAs are not getting signed quickly enough. What is your assessment of how quickly we are moving towards this 500 gigawatts target, and what are the major issues, if any?
So good morning, and thank you for having me. Yes, we can always say that the speed is probably not at that level at which we are expecting to achieve our overall objective of 500 gigawatts by 2030. And yes, there are multiple challenges, and probably this has been discussed at multiple levels. I could probably list down a few. Among them, of course, are land acquisition challenges. There are challenges with transmission evacuation. There are challenges with execution in terms of getting the PPAs off the ground, as you mentioned. So these are all challenges which are there. And in fact, there have been a lot of focus also, if I may say so, in terms of what's the support being provided. Because I think there's also one report which says that the government is actually again pushing the coal-based power. So it's also whether the question whether the government has kind of taken the foot off the pedal for renewables. I don't think so, but yes, those are all challenges which are there.
Is there a threat that we'll miss this target, 500 gigawatts by 2030? I mean, I don't get the sense, hearing you, that there's too much of an urgency that something needs to be done. I mean, if you just put it in perspective for us, are we moving along at a fine pace?
I would say we are moving along at a fine pace, but there's always room for improvement. And 500 gigawatts, I must say, you see, that's a very good ambition to have. I am quite hopeful that we'll be ending up very close to that. But obviously, there are challenges. I mean, look, for example, transmission probably today is one of the biggest challenges because the pace at which the evacuation system is working is probably not in line with what the renewable energy producers want it to happen. And one of the reasons why, if you check with the CTU website, you'll find that there's a long queue for connection. And the earliest now apparently available is around 2029. So a lot of activity which is happening is also incumbent upon the fact that transmission needs to be pushed further quickly. Of course, there's also on the other side, even the capacity which is already operational. I understand there are challenges in actually pumping the entire power because there are probably some segments of the transmission system which are not up and running. So for example, if there's a 1,000 megawatt renewable project, it probably does not get fully scheduled for 1,000 megawatts also at various times during the day. So these are all challenges, and we need to move quickly on transmission.
Got that. There are questions whether the government has taken its foot off the pedal, but you don't think that is correct. We have Sumit Kishore also with us. Sumit, good to speak with you after a while.
Yes.
You want to reflect on some of what Mr. Bhargav said and your thoughts on this?
Yeah. Good morning, Prashant. I think to add to Mr. Bhargav, despite the on-ground challenges, India has added almost 33 gigawatt of capacity in FY25, an increase of almost 28% on a year-on-year basis. So if you think about it, 33 gigawatt is the highest capacity addition in a fiscal ever. The next highest was 30 gigawatt in FY16, which was at the peak of the thermal capacity additions in the last cycle. So out of 33 gigawatt, almost 24 gigawatt was solar, 4.3 gigawatt was wind. So it has been a decent outcome. What actually happened last fiscal was that the peak demand grew just 2.7%, which was quite weak. And post-COVID, you had the weakest power demand growth in the country of just about 4.2%. So weak power demand and declining battery and solar module prices have allowed DISCOMs more time to finalize their power procurement plans, as a result of which you see a large pile-up of renewable letter of awards of over 40 gigawatt where PPAs have not been signed. I think this fiscal, again, so far, April power demand was just 2.2%. May power demand is down 2% year on year so far, and peak demand is at 231 gigawatt so far in May. And end of May last year, it was 250 gigawatt. So you're in a summer season where peak demand is actually down on a year-on-year basis. So I think more than the execution challenges have been evergreen. They will remain. But I think over the next 2-3 years, what is very important is that power demand growth, if it revives itself, you would basically find everything else falling in place. In FY26, the worst risk is that there is almost 8 gigawatt plus of coal capacity addition that could come on stream, even if there are 6-month delays versus CEA target. So, if that is accompanied with weak power demand and strong RE capacity addition, DISCOMs will be able to wait even more to sign PPAs.
I get that. Sumit, for the listed universe here, for your Varis and Premier and, what does this environment mean? Because then this will keep piling up. And there is a fair bit of demand, which is additional demand for solar modules, etc., which is coming up. And for these two companies specifically, this is basically there is strong demand, very strong demand for maybe 2 years. But then after that, what? Because there is a lot of capacity which is coming up. So, just your thoughts here.
India's power demand is a secular growth story. In the last 15 years, India's power demand grew at a CAGR of 5%. Possibly, it can grow faster in the next 5 years because you have new levers of power demand growth like data centers, EV charging, green hydrogen. So I think there is a long runway of capacity addition that India can sustain. Think about it. Simple math is India had a 250 gigawatt peak demand last fiscal. If you have 6% power demand growth, that's 15 gigawatt. If you have to meet that using wind, solar, where the PLF profiles are lower, and even with a bit of thermal, you still have 40% say average PLF. So 15 divided by 0.4 is 37.5 gigawatt of capacity addition just to keep pace with the demand growth in the country. And that will keep growing every year. So there is a long runway. Let us not be very skeptic.
No, not at all. In fact, I was just looking at the trends, I think, out of April, that while overall demand was soft, this evening deficit issue always leads to spikes, right? And I believe on the exchange on IEX, prices were touching almost 10 rupees per unit, just to meet that short-term evening, demand deficit. Sumit, from the listed stocks point of view, and I'm not asking short-term, 1 or 2 months or 3 quarters, but if someone is to play the renewable theme from a portfolio perspective, then how would you advise them to do it? Would an integrated player like Tata, which is giving you both traditional as well as renewable, would that be the way to go? Power exchanges, stocks like Power Grid, etc. What do you play in the power supply chain?
No, almost across the board in power sector, we have seen over the last few years that the pace of capital expenditure has gone up meaningfully, led by green growth. And even aspirations for companies 5-6 years out have a meaningful compounding in EBITDA led by green growth aspirations. So companies which are able to sign PPAs and have decent visibility on earnings compounding, EBITDA compounding over next 2 to 3 years stand out. So in that bracket, you have companies like JSW Energy, which have seen a healthy dose of both organic and inorganic growth, and even Tata Power, which has a more integrated approach to not just IPP capacity addition, but solar equipment manufacturing and solar EPC, which is seeing decent growth. There is possibly the privatization of DISCOMs in UP, which is standing out as a big catalyst for companies in the sector, in the distribution space, including Tata Power, Torrent Power, CESC, and so on. So I think all in all, even exchanges are having a party right now because in the advent of weak power demand growth, there is a lot of coal availability. International coal prices are flattish, and you see that exchange prices, even though they are spiking in the evening, on a year-on-year basis, exchange prices are down 15-20% year-on-year, which is welcoming the DISCOMs to come to exchanges, welcoming C&I customers to go to exchanges to optimize their power cost. So, which basically means that exchanges saw earnings growth of 20% plus in the last financial year, and even so far this quarter, volume growth has been quite strong, despite power demand growth being weak in India. So I think this is a secular story where India will follow Europe and other developed markets, where over a period of time, penetration of short-term power supply in India will keep going up. 10 years back, we were at 3-4%. We are at 9% plus of total power supply in the country, which is being transacted on exchanges today. I think this will go up to 15-20% in the next few years.
Sumit, you said don't be too skeptical. In stock markets, always be skeptical.
Yes.
Even for the best laid stories. I think that's got to be the motto.
It was more from, operational and,
Yeah, I get that. My question, though, was only about Waaree and Premier and, solar modules. It was not about the overall, how much will power demand grow, and you said those numbers, etc., all make sense. But my question was about these two. I mean, will there be overcapacity, which you yourself provided the context for?
No, so that's a separate question on the solar equipment manufacturers. I think India already has excess capacity for solar module assembly. We have crossed 70 gigawatt in terms of annual manufacturing capacity for solar modules. India is likely to achieve self-reliance for solar cells within a couple of years, and even backward integration of wafer ingot is likely to pick up sharply here on. But players who evolve their offerings in clean energy transition will be better off on margins and profitability, even as industry-wide ROCE normalizes with potential oversupply of the module manufacturing value chain. So I think India will have to find new export destinations like Middle East, because you can't, the geopolitical uncertainties and the flip-flop on decision-making, or the uncertainty in US is likely to sustain. But if you have local manufacturing in US, for example, that could help you overcome some of this. And US is being quite skeptic of importing stuff from China or countries which are seen as fronts for China in Southeast Asian region. I think India will benefit out of these interventions.
Okay, all right, gentlemen, I think we're completely out of time. Just 10 seconds answer, just checking with Mr. Bhargava. So final word, we discussed a couple of issues that you highlighted, labor, PPAs, etc. Is labor availability at all an issue for the sector right now?
Yeah, it's always a challenge because renewable sector is labor intensive, especially during the execution phase. And just, if you allow a couple of more seconds, I just wanted to add to what Sumit said. I think you missed out on NTPC Green, Mike's company, so that's also in a good space, if I may say so. So having said that, yes, you see, the story of renewables is good. And I just wanted to have a quick word also on the peak power, which you mentioned. And that's actually a good story for renewable space also, because a lot of storage, like RE plus storage tenders are there. And these are actually the most important plugs or the way out for meeting the peak demand, because whatever coal capacity is coming up, that will take its own time. What you start today will take at least 5 to 6 years. But this battery storage can actually come up within the next 12 months. So while India has moved on that, I think we need to step on the gas much faster, because that is where the peak power challenge will be taken care of. So that's one important thing which government, of course, is doing, but we need to get people, states and the PPAs happening so that these things get off the ground. But yes, to answer your question on labor, that's always a challenge, because ultimately today a lot of work happening across the country in various sectors.
Sure.
At any given point of time during construction, you need a lot of people to get the project off the ground.
Absolutely. Well, we have some challenges, but then there's a big push. And perhaps these are not insurmountable issues. That's the sense we get after talking to both of you. Thank you very much for joining in. With that, we're completely out of time on this edition of Bazaar. So we're leaving the markets in a pretty good shape. Nifty's been chugging along this morning. Do stay tuned. Chartbusters will take the action forward.